It's hard to have much of an inflation problem if wages are still quite quiescent.
We're recovering very quickly, but a lot of people aren't coming back into the jobs market.
People will get more comfortable coming back to work, but they're demanding more wages to do it.
The market's a little too complacent about the Fed not even talking about tapering.
We are still awash with excess liquidity, and that helps to support a lot of valuations.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene is simulcast. Bloomberg Radio, good morning. Bloomberg Television, good morning. On a Monday, Matthew Miller in for John Ferro this morning. Lisa, I look at the screen, I look at the jobs report. We got all this policy stuff going on. You know what? The 10-year yield, 1.57 handle. No one expected that.
Well, to me, this is the fascinating thing. We're actually getting so many developments, whether it's on the potential tax fronts or whether it's on whether the Fed will or will not taper. And you're seeing nothing in markets. I mean, for all intents and purposes, it's a no-drama Monday. Sleepy Monday.
It's a no-drama Monday. Yeah, go, Lisa, I'm going to go with that because a no-drama Monday signifies nothing's going to get done. There's a huge belief in the market that a lot of this is noise. We'll dive into it through this day, through this week as well. But Lisa, I look at where the yield is and where the yield is, real yield is, which is unchanged. What a story from where we were 1 week or 1 month ago.
The idea here, especially because of the Friday jobs report, is that perhaps the Fed is correct, right? They have it under control. My question is, if you look at some of the underlying data, you can see wage pressure starting to increase, particularly in the industrial side. What happens if you get an increase in inflation and yet we don't see material improvements in some of the headline labor market metrics? What does the Fed do then? And I think that increasingly that's going to be a conundrum people are going to try to address.
It's going to be really interesting to see. And, Greg Villiers already out with an exceptionally sharp note this morning, which I think really underscores the stasis that's out there. Europe has its own stasis. Matt Miller, I'm thrilled you're with us because to me, Europe is fascinating. Forget about the mess in the United Kingdom with the virus, which you beautifully underscored in the last 20 minutes. In Europe, is it essentially thumb up into the summer or thumb down?
Well, it looks like thumb up. In fact, we're all reopening at a pretty decent pace, and inflation is coming back to some extent. In fact, on Thursday, we're going to have an ECB meeting, and everyone expects the central bank, Madame Lagarde, to raise their inflation targets again. They're already expecting 1.2% this year, 1.5% this year. That sounds like not very much from where you're sitting, but for us, it's a dream come true. The question is, can they keep it going? Can we continue to reopen at this pace?
The reopening that we're seeing is really spread out around the country. And again, we'll have the OECD Secretary General with us, with his Australia being particularly challenged. Matt, help me with data right now. We got futures -8, Dow futures -4, and the VIX 17.13. Matt Miller, what do you see?
Well, I'm watching the currencies pretty closely here. Look at the euro right there. At 121.59, we're getting pretty close to some of the support levels that the analysts I talk to are watching. So we continue to drop down, which is interesting because you expect that the ECB gets a little bit more hawkish at its next meeting and maybe starts to change some language. You could see a turnaround there. Mm-hmm. The 10-year yield you already talked about. Forget about the magnetism of 162. That's dead and gone. And we see that across bonds here in Europe as well. German yields climbing up to less than 20 basis points of negative yield, although we're still negative across the spectrum, really, all the way out to 2 years, even in Greece and Italy. And I see NYMEX crude right now coming down a little, but still at $70 a barrel, almost $70 a barrel for NYMEX crude. That looks like a Brent quote.
Yeah, and gold at 1886. Brent crude 71.48 with a 72 print earlier last week. I should know Bitcoin 36,000. Michael McGlone, tough duty. Miller's like struggling in Berlin. Abramowicz is lost in the Adirondacks, and Michael McGlone of Bloomberg Intelligence in Miami, being very Bitcoin. Somehow I know Mark Gurman, Lisa, today will be looking at the Apple conference.
Yeah, this is what a lot of people are watching today because, frankly, there's not a lot else happening today. Let's just be honest. Apple kicks off its Worldwide Developers Conference. They potentially could announce a new iPad Pro. Tom, you can get this for a vet bill as well as Afterthought and all the rest of the family so they can leave it under the couch. Basically,
already ordered the new one.
I'm sure you have.
Orange is our chosen color.
I'm sure you have. It can join all of the AirPods that are they're also under the couch. There is a question here about what Apple can introduce that can keep the momentum going. Interestingly, you see the shares down 0.6% in pre-market trading. This is not because of the developers conference. This is because ostensibly of the tax agreement by the G7 leaders. Question is, though, why it's not down more considering the potential consequence to its balance sheet, something we'll be discussing throughout the morning. Today, President Biden will be meeting again with Senator Shelley Moore Capito, who has been really spearheading the Republican effort. This is yet another meeting. This actually, interestingly enough, Terry Haynes of Pangea Policy came out and said this is actually positive for the prospects of getting a deal done because there is no deadline. This can continue to be negotiated. He puts the chances of a deal getting done at about $1.25 to $1.5 trillion at about 60%. I love that he comes out with percentages. Also today, I love this story because it really highlights where we are in the COVID fight. Teens, the age of 12 to 15, can actually start getting vaccinated in Germany. They just approved the Pfizer-BioNTech vaccine for younger teens. We're seeing a massive decline in the number of infections, Tom, across the globe, about the lowest in 3 months globally. In the United States, the lowest level of infections since March 2020, excuse me. We are getting ahead of this. And the question is whether the data can catch up quickly enough.
Very good. Nice briefing there, and particularly on the good news on the pandemic worldwide. There are some challenging lockdowns here and there, but all in all, very constructive. We're thrilled to start strong this week with Bruce Kasman. He's with J.P. Morgan, their chief economist, head of global economic research. He herds the cats at J.P. Morgan, trying to get out a cogent message on economics. Bruce, linking global inflation with the recovery that we're seeing, dovetail those two in. Is it a good inflation or a bad inflation?
I think there's some of both here. On the spike that we're seeing, there's definitely some problems in terms of companies adjusting supply to demand. That's the bottlenecks you see in the semiconductor, that's the used car prices. There's a bunch of those forces that are pushing up inflation, which is not great in terms of what we would like to see. The other side of this, though, is that we are seeing price normalization in what are depressed levels of service prices as we're seeing activity picking up. And I think that's obviously constructive. The bottom line, though, is we're getting a big spike in inflation here, and we're looking for another big number this week with a 0.5 rise in the U.S. core CPI.
What happens? What does the Fed do if we see that increase in CPI this week, if we see those inflationary pressures, but we don't see material improvement in the pace of job gains akin to what we saw on Friday?
So I think there's three things the Fed has to really work on. One is, I think, continuing to guide us that it's not going to change rates anytime soon in response to an inflation spike that they think is largely temporary. We think they're going to continue to guide that rates are going to at least be on hold through the end of 22. The second thing I think they need to do is start telling us that if they're wrong, and certainly they could be wrong, and inflation is more persistent, that down the road they can do what they need to do to keep inflation under control. And I think in that regard, they will, if not encourage, at least tolerate a rising expectation of rates over 23, 24. And then finally, what we're not going to get in June, but we need is more clarity about the balance sheet. I think they're going to tell us they're talking about it, but they're also going to tell us it's too soon to really lay out the parameters of what they do in terms of tapering and balance sheet movements more generally.
Bruce, our Bloomberg opinion columnist Marcus Ashworth today says it's really difficult to model the U.S. economy because the ferocity has been driven by monster fiscal injections and because the Fed has been deliberately vague about what inflation, what flexible targeting really means. How much harder is that making your job?
Well, I think forecasting is always difficult, particularly the future. Obviously, we're going through a very volatile period, but I think if you take the broad contours that the economy is entering a boom phase led by the consumer, that Europe is joining it, and as you just mentioned, the news on vaccines and viruses starting to look good globally. The simple issue is we're in a very strong phase of growth that's not going to go away anytime soon. The spike in inflation, I think, is largely temporary, but whatever is going to happen here, the Fed for the time being is going to be relatively cautious and continue to hold the line. And I think on the inflation targeting side, the Fed wants inflation to get up to the mid-2s for a while. It doesn't want it to get above 3, and it wants it to settle at 2 in the medium term. I don't think these parameters are that far, far away from where we might think ranges are, so that there's a lot of uncertainty. Executing is obviously very difficult, but I think the Fed's pretty clear on what it wants here.
Bruce, Michael Ferroli and your team have led the way on our potential GDP, just the sort of where are we from a demographic and economic standpoint. Have you tweaked your potential GDP to be a more optimistic statistic coming out of this pandemic with all the stimulus?
It's an interesting question, and we're struggling with that. And we have not changed our view that U.S. potential growth is around 1.5. And as you can see in the latest employment report, and you can see more generally, there's been damage done to the supply side on labor. But at the same time, we've had a big productivity surge. Some of that is the rotation and growth to higher productivity sectors. It still remains to be seen what happens here in terms of lasting damage from this effect. And we're not at this point taking a view of really trying to change that view of a 1.5% potential growth rate.
Dr. Kasman, thank you so much. Bruce Kasman, J.P. Morgan chief economist, head of all of their global economic research. Lisa, a really good conversation there on a potential GDP, which is frankly Europe, like most Americans, I'm sorry, are simply not adjusted to a sub 2% potential GDP.
No, and this is a real question of whether we can get that sort of warp speed that can get us out of the hole that we are in. If we don't, I really raise this question about the inflation. You asked a really good question, Tom. Is it good inflation or is it bad inflation? I was out in California this weekend, don't ask, and you saw the price of gas at $4.50. What does that do to consumer appetite?
Well, where gas is where it's gas. Matt, how does Europe do high gas prices?
I mean, I was going to say I would pay $4.50 to be able to pay $4.50 a gallon for gas. I mean, that is still pretty cheap compared to what I'm tanking with. And I use, I'm getting 10 miles a gallon with my truck here. So we just have other ways. Are
you the only one in Germany with an H2? I mean, are you the only one driving the big Hummer?
He has his own oil rig.
I'm an H1 man.
Oh, H1.
I'm an H1 man. I need the 6.7 liter
Looks like
Duramax.
you're from one of the U.S. military bases. Matt Miller with us and Lisa Abramowicz. Bloomberg Surveillance, Matthias Cormann next.
With the First Word News, I'm Ritika Gupta. U.S. Treasury Secretary Janet Yellen says higher interest rates would be a plus for the U.S. and the Federal Reserve. In an interview with Bloomberg News, Yellen said President Biden should push ahead with his $4 trillion spending plan, even if it triggers inflation. She says any spurt in prices resulting from the rescue package will fade away next year. Some of the world's biggest tech companies are welcoming the G7 agreement on a minimum corporate tax rate of 15%. Facebook says it's a first step towards certainty for businesses. Amazon says the process will lead to stability in the tax system. The agreement is designed to help countries impose taxes on tech giants such as Facebook and Amazon, but it may not be implemented for years. In China, the trade boom continued last month. Exports grew almost 28% in dollar terms from a year earlier. That's weaker than forecast and below the pace in April, but it's still well above historical growth rates. Meanwhile, imports soared 51%, boosted by rising commodity prices. And in Germany, Armin Laschet has boosted his chances of succeeding Angela Merkel as Chancellor in the final electoral contest. Before September's national election, Laschet guided the Christian Democrats to victory in the country's poorest state, Saxony-Anhalt. The outcome will help ease doubts about his suitability to lead Germany's conservatives. Global News 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
The G7 has taken significant steps this weekend to end the existing harmful dynamic, making commitments today that provide tremendous momentum towards achieving a robust global minimum tax at a rate of at least 15%.
The Secretary of Treasury of the United States in London, Soleil Motion leading all of our coverage there this weekend. And if it was under your radar, particularly on the East Coast in 90-degree weather, really, really something as well. Before we continue this story, I do want to bring to your attention right now William Dudley with a scathing essay on Bloomberg Opinion released moments ago. I loved his last effort, which was much more supply, demand, and sequential dynamics. This is just, Mr. Powell, perhaps you have it wrong. The problem is that the Fed has put the new strategy into practice in an unnecessarily extreme way. Cooling things off will require the Fed to increase interest rates much faster and further than it would if it started raising rates sooner. We'll talk about that through the morning as well. Matthew Miller in for John Ferro, Lisa Abramowicz, and Tom Keene. With us, Martin Schenker, who's in charge of G7 treaty analysis. Marty, that's the heart of the matter. This is a treaty.
It is a treaty, and the thing about treaties is that they have to be approved back home by the legislatures. And as our stories point out, this could take a very long time.
But what are the implications, Marty, when it comes to U.S. tax policy, since there are some, in order to get some of the policy up to speed with what the global agreement has?
Well, I mean, what it's really going to mean is that, in order to implement a 15% minimum tax, you're going to have to change legislation in the U.S. You're going to have to apply that minimum tax to companies. And as we can see, Joe Biden's having a hell of a time getting Republicans to get on the same page on taxes.
This is something that we were talking about last week, Marty, because the Biden administration floated the possibility of a 15% minimum corporate tax instead of seeking a 28% rate. And to me, the fascinating thing was that would be a floor, meaning no matter how many deductions you have, no matter how many loopholes you've cajoled Congress to give you, you still have to pay 15%, which for so many companies would be worse than having just a 28% rate.
Yeah, and I think you're talking about companies like Amazon there. And it's true. It would, for some of us, remember the alternative minimum tax that used to be in play, and that's the same thing for companies that was for individuals. You would have to pay a certain minimum amount, and that would be a sea change.
We'll talk to Emily Wilkins later here, Marty, on what's going on in Washington. But I really want to underscore, as John Stolfus does at OPCO this morning, the motion interview with Janet Yellen in London as well. What did we learn from Soleil's interview with Secretary Yellen?
Well, she is, and rightfully so, is making the case that, if interest rates would have to rise as a result.
She said interest rates rising is a good thing.
Is a good thing. And there are a lot of people who agree with that. I'm sure the banking CEOs agree with that.
Well, it's a financial plus thing, but these are, I thought it was pretty bold statements I mean, maybe it's an economist rationalizing with their esteem as a central banker's treasury, but that was quite a weekend for a Secretary of Treasury.
Yeah, and, she sort of ventured into the area of monetary policy as a Treasury Secretary, which is sort of not something you're supposed to do.
I'll say.
But, she's very comfortable in her skin.
She's as rude as Abramowicz, and that's rude.
Tell me about it. Well, look, Janet Yellen, what was she saying? If we ended up with slightly higher interest rates, it would be actually a plus from society's point of view and the Fed's point of view. We've been fighting inflation that's too low and interest rates that are too low now for a decade. That is a quote to Bloomberg's Soleil Motion. There is a question here how much, Marty, this actually goes against Jay Powell versus really underscore the main takeaway here, which is that they do eventually want to normalize policy. However, there's a larger question, which is, do we really even want this? How is this being viewed in Washington that the Treasury Secretary is really acting increasingly like her former role as Fed chair?
Well, I don't think Washington as a whole really delves into the details like they do on surveillance, But I do think it's interesting that Bill Dudley, as Tom pointed out on Bloomberg Opinion, is saying, interest rates are going to have to rise, but they're going to have to rise a lot bigger, more, and a lot faster than the Fed realizes. And you have him and Larry Summers, these traditional, more, former policymakers, sort of lining up in opposition to current economic policy.
Yeah, Dudley says that when they start to raise rates, if they push unemployment up by just 0.5%, that's very likely to cause a full-blown recession again. I wonder about the inflation side of things. Yellen says a little bit of inflation is a good thing too, and that seems to be consensus, Marty. But when I was a kid, you know, my grandparents lived on a fixed income. My parents, as far as I know, live on a fixed income. And that's not helpful to them, inflation. Doesn't that hurt savers? Doesn't that hurt retirees?
Well, it depends where the inflation is. If interest rates rise, I mean, money market funds are returning close to zero. So retirees who have fixed income, but their investments, their 401ks are going nowhere. So it depends where that inflation shows up.
I got to ask you. I mean, I'm going to get nothing out of London today, so you don't know who can help me. Lilibet Diana. I mean, they hit the ball out of the park on the name of the new baby, right?
Yeah, I think
could not have gone. They could not have gone wrong.
It was trending on Twitter, so it must have been a really good choice.
A large success, to say the least. Schenker didn't expect that question this morning. Martin Schenker in charge of our royal coverage, or less royal coverage as well.
No. Hold on a second, Tom. Is that really the barometer of success, trending on Twitter? Did Marty Schenker just weigh in on that?
I once trended on Twitter for like 3 seconds.
Oh, yeah, for what? BitDog?
Yeah, I don't know what it was about, actually. I can't remember. I was like, oh, really? But there it is. Twitter's a mess. I mean, they're trying to make changes, Lisa, and it really folds into technology. Matt Miller, are you using Twitter a lot?
You know what? I'm on Twitter, and I wish I had the courage to commit Twitter side, because it really just takes up my time. It's a real time suck.
Yeah,
I don't like
it's
it.
a really interesting conundrum right now. They're trying to do some innovation there. That leads into the technology debate, certainly behind so much of what we see on taxation. Will be one of our themes again through the week and all this. Lisa, when's this conference? Do I really have to lose a surveillance nap to watch the Apple conference?
It's at 1 p.m.
today?
That is going to be the keynote.
It's in the heart. Come on.
I mean, I don't think that you're going to lose the surveillance nap for this. I think it's interesting in light of the fact that there has been a revolt among Apple workers after being told that they had to come back to the office 3 times a week. Did you read about this?
Yeah.
And they basically said, no, you don't understand us, and they protested it. Tim Cook, you aren't listening to our feedback, raising a question of whether it's legitimate for employees to push back against their employers, for employers to demand coming back to the office.
We're going to have a really definitive interview on this in the 8 o'clock hour with an academic from Stanford who is truly expert on the actual research of really the research of work from home. We're really looking forward to that as well. The resilience of the equity market defies Lisa Abramowicz. It is a bull market right now with red and green on the screen. The Dow futures up 6. I'm just quoting that for Ferro. Dow futures 6. Let's do a Dow level for John. 34,749 on the Dow level right now. The VIX 17.12. Coming up, Urian Timmer of Fidelity, an important interview. Stay with us. This is Bloomberg on radio and television. Bloomberg surveillance on radio and television. Good morning, everyone. Tom Keene, John Ferro, and Lisa Abramowicz. Mr. Ferro off. Matt Miller in Berlin with us. Romaine Bostick scheduled, I believe, if he gets here in time. So the Sikorsky has trouble in the 90-degree weather. We'll see if we can get Romaine here for the next hour as well. Right now, a really important interview, and particularly for those of you that enjoy the heritage of Wall Street. Urian Timmer is with Fidelity Investments. He's got a fancy title called Global Macro Director, but the real Urian Timmer is the keeper of the charts. At 82 Devonshire in Boston is the most important paper display of charts in the business. It truly is the Vatican of technical analysis in the world, and we're thrilled that Mr. Timmer could join us this morning. Urian, which chart matters the most right now?
Well, many of them matters, but I would say the one that I follow, if I only had one indicator, it would be the chart of real rates, especially the 5-year real yield, so the 5-year TIPS real yield. And that one is near minus 2%. And I think that level and magnitude of negative real rates is really what has driven a lot of this market. So obviously that is highly reflationary. A period of negative real rates. We saw that during World War II when we had financial, et cetera. So real rates, especially the 5-year, because that one is most impacted by the Fed, right? Because the Fed is buying in the belly of the curve. It sets forward guidance out that long. So the 5-year rather than the 10-year, that to me is the chart right now.
You're and Tim are on the same page as Lisa Abramowicz. Lisa, you really highlighted the distinction here of the 10-year and the 5-year inflation-adjusted yield.
Yeah, the question that I have, Urian, is that this market has been rather boring, right? I mean, it looks like people think that the Fed has it right. They're kind of waiting for something to change. You think that things aren't quite as boring. Can you explain?
Yes. So yeah, we look at the 10-year, right? It's 155, 160. The high was 175. That last run up to 175 started to be driven more by real rates going less negative rather than inflation expectations going up. And that is a huge distinction, right? I mean, I think the Fed, as well as the markets, don't really mind rising rates as long as they're rising for the right reason, which would be inflation. But if they're rising for the wrong reason, which would be real rates going up or becoming less negative, different story. Then you get into taper tantrum territory, triple T's there. But for the stock market, market hasn't done anything. Well, it's gone literally sideways, but beneath the surface, you can see rotation, right? So earlier in the year, we had the meme stocks. I mean, they're kind of back now, but with the meme stocks, we had the kind of the IPOs, the non-profitable tech baskets. We had, the secular growers, all very sensitive to the liquidity environment. The secular growers, of course, very impacted by rises in the discount rate per the discounted cash flow model. And so one by one, these kind of high-flying momentum sectors kind of were taken out to the woodshed, and the crypto stuff is kind of in the crosshairs right now. And so even though the S&P just sits there at 41, 4,200, lots of churn underneath. And, you could say even that that's a correction. And, I bring it back to kind of the financial crisis, 2009, 2010. We had that enormous rally off the March 09 low, 75% gain. Then QE1 ended in April of 2010. Market then fell kind of a very uniformly, 15, 16% before it resumed the bull market. We're kind of in the same transition where we had a valuation-driven phase of the rally, the early cycle phase. Now we're moving towards an earnings-driven phase of the rally. So the rate of change of the PE is peaked. The rate of change of trailing earnings is flipping from negative to positive. But in that transition, sometimes you get a little indigestion, and because usually the Fed is in there trying to normalize policy. And of course, that's the big discussion we're having. So whether we see a correction here, a short-term correction, or whether it's all underneath the surface is something that we don't really know. But there is stuff going on, for sure.
Wait, Urian, can you elaborate a little bit? There's a lot there to unpack. This idea that potentially the market is due for a broader drawdown, and it could be triggered by a Fed policy error, or even just the suggestion of tapering. Is that what you foresee in the next few months?
Yeah, and I wouldn't even call it an error. I mean, it's hard for the Fed to maintain the degree of accommodation when the output gap, which of course opened up very, very widely during the pandemic, is closing fairly rapidly. Now, we've had two payroll misses in a row, and maybe that pushes the taper conversation from their June FOMC, which of course is right around the corner. Maybe it pushes it to Jackson Hole in August. But, it's inevitable that conversation has to happen. And even when you hear things from the Treasury Secretary, they're almost kind of hints that, to kind of give the Fed cover that, it's okay to normalize policy because conditions are better. But, there is still a gap, right? The U3 unemployment rate is still about 1.6% percentage points above what's considered the natural rate of unemployment, so kind of a full employment situation. And the U6 is about 6.5 percentage points above. So there's still a lot of wood to chop, but that gap is closing as the economy reopens. And doing 120 billion a month, including a lot of MBS, it becomes hard to justify that as the economy fully reopens and goes back to full capacity.
But the interesting thing to me is you're making a parallel between now and where we were in 2010 or 2013, I guess was the taper tantrum. But the point being, we had this earnings-driven rally on the S&P from 1,000 to 3,000, basically, and you see that as ahead of us after possibly a correction, possibly not.
Yeah, so we're just passing the baton, if you will, and this happens all the time, right? So price bottoms when the market gets oversold and too much bad news has been discounted. We saw that last March. We saw that in March of 2009. We see that basically at every cyclical bear market bottom. And then the initial phase of the rally comes because the Fed is pumping money into the system. You get that valuation-driven rally where the worst stocks are going up the fastest because they've gone down the most. So companies with bad balance sheets, for instance. And then the delta, the rate of change of the PE starts to peak, and the delta of the rate or the rate of change of the EPS bottoms, and then the two flip over. And we're at the point where they are now flipping over. Same thing happened April 2010 when QE1 ran out. And if you remember, of course, it ended up with the Fed having to QE2, which I'm sure it wasn't planning to do back in April of 2010. So we don't know what will happen here. If a full-on taper, if it pushes the 10-year north of 2%, which is that's not a prediction, but let's say if it did, and the Fed then decided that we can't afford rates above 2 or 2.5, maybe we then get another bout of QE to try to keep rates low, but that's kind of one of the future in the chess game, not right now.
How much does inflation matter, Urian? I stumbled across a chart this morning which really shocked me, and it's basically just core PCE. The jump that we've seen over the last few months is pretty impressive. I didn't put this chart in log yet. I'm asking our New York City chart producer, Dan Curtis, to do that for Tom. But we haven't seen this kind of jump in core PCE in the last, since I did my GED in 1991. Roger Bootle, who wrote about the death of inflation back then, says we could be at the beginning of a sea change now. What are your views on inflation?
Well, that is the big conversation that we're all having here among my colleagues at Fidelity, and of course everyone else is as well. We know we have transitory inflation, and by definition, it is transitory just from a rate of change base effect, aspect, because you always have to look at the level and the flow, right? So we know the flow is going up because we have the base effect from a year ago. We have the reopening dynamics, we have bottlenecks, it's low inventories, et cetera. So the increase in the CPI or the PCE was, a mathematical kind of certainty almost, and that rate of change will peak at some point in the next few months, and then it will come down. But then the question is, what does it come down to, right? If it went from 1 to 5, and then it goes to 2, and then it goes back up to 4, at that point you start to get structural inflation because the level kind of settles in at a higher point. Tom can relate to this as a chartist. So you start to seeing those higher highs and higher lows. That's what we saw in the mid 60s into the early 70s. And again, I don't want to draw that parallel because the 70s were not a pleasant period. But for the markets, again, if rates are rising because inflation is rising, I think the markets, both the bond markets, the stock market, the Fed will be okay. And sectors that work, right? Energy, financials, materials, industrials, all are very positively correlated to changes in the 5-year yield. And then the consumer staples, the bond proxies, tech is very negatively correlated. So there's going to be winners and losers, and that's what the market is already figuring out right now. But ultimately, from my perspective, the big question is if inflation does become entrenched, that's going to undermine the 60-40 paradigm, because at that point, the 40 is no longer going to be negatively correlated to the 60. And then you need to start tinkering with the portfolio to make sure you have the right things in that 40. And that very, very well may include gold and even digital gold.
Urian, thank you so much. Urian Timmer with Fidelity. We have to get you back again soon. Head of Global Macro Direction at Fidelity as well. Lisa, I look at where we are and with the Fidelity mantra, and I really wonder about equity forward. Do you go over-diversified? Do you go more focused diversified, like a Peter Lynch model of years ago, or even the Fidelity 50 fund? I mean, there's a huge debate about this.
Well, and a lot of people have been calling for the death of the 60-40 portfolio for a long time, and yet it has performed pretty well consistently, with bond yields continuing to plunge into new low territories. I do wonder, Tom, when people say that we're entering a new inflationary regime, what has changed demographically from a debt load perspective, from an innovation perspective, that could lead to that kind of inflation. And right now, the market isn't buying that story, but there are more people on the
Modern monetary theory
coming out.
MMT.
Well, okay. Perhaps, but we're not necessarily seeing that with respect to the velocity of money. We're not yet seeing that with respect to wages flying. Not saying we're not going to, but Tom, this to me is one of the questions.
We're going to have to see. To me, it's absolutely fascinating, and so much of this is about what you do with your portfolio forward, given all the easy money that's been made for a select few. Chair Yellen still active as Secretary Yellen, her splash over the weekend, and a new headline out from Secretary Yellen here at a summit, Select USA Summit. U.S. economy transitioning to a pre-pandemic state. That's the same for Matt Miller. He's transitioning to a pre-pandemic state. Stay with us.
With the First Word News, I'm Ritika Gupta. Bank of America President Brian Moynihan says consumer spending has surged amid the reopening, and he says much of that is due to leftover stimulus money. Moynihan told CBS News that spending by B of A customers is up 20% from 2019. In Mexico, President Andrés Manuel López Obrador's party took the lead in midterm elections for the lower house of Congress, but a survey indicates his coalition won't retain a supermajority needed to pass constitutional reforms. In Peru, the presidential runoff is still too close to call. Investor favorite Keiko Fujimori trails leftist Pedro Castillo. Fujimori is the daughter of jailed former president Alberto Fujimori. Bloomberg's learned that KKR is close to reaching an agreement to buy Atlantic Aviation from Macquarie Infrastructure. The deal could value the airport services company at about $4.5 billion, including debt. Atlantic Aviation offers hangar space, aircraft maintenance, and other services. And shares of Tesla are lower. The electric car maker called off plans to build a Model S Plaid Plus. That's the longer-range version of its high-end sedan. Tesla CEO Elon Musk tweeted that the Plaid Plus will be cancelled because the Plaid version is, quote, just so good. And it would be one of the biggest leverage buyouts of all time. A consortium of private equity firms reached an agreement to buy medical supply company Medline Industries. Bloomberg has learned the transaction is valued at more than $30 billion. The consortium includes Blackstone Group, Carlyle Group, and Hellman & Friedman. Singapore's GIC will also invest. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Ritika Gupta. This is Bloomberg.
I think the biggest issue is the communication that happens via social network mechanisms that really allows for things that are inflammatory, things that seem more challenging, things that seem more dangerous, but are yet not fact-based, to really spread like wildfire.
And to Pekos on Friday with a briefing there on the pandemic. We continue that story forward. We welcome all of you. John Farrow's off. Matthew Miller in Berlin in the summer with Lisa Abramowicz and Tom Keene. We've got futures red and green on the screen. SPX -5, Dow positive 25. The VIX, I'm going to call it stasis, 17.06. The headline statistic for me to 4 digits, 1.5789 on the 10-year yield. That's extraordinary for any measurement. As Lisa mentioned earlier, 162 is where we were, and now we're 5 basis points in as well. Brent crude 71.48. Joining us now, Joshua Sharfstein with Johns Hopkins, the Bloomberg School of Public Health, and their vice dean. Over the weekend, Joshua, I was shocked at the medical statistics for the hospitalization of teens with COVID. The idea that 30% are in intensive care, that 5% are on a ventilator is, well, describe for us COVID in kids. What's it really look like?
Well, it can look like COVID in adults. It can be quite serious. It's less likely to look like COVID in adults, but adolescents can absolutely get sick. And when they do, it can be quite serious. You know, what we're seeing is that the variants that have emerged appear to be more likely to get kids sick and potentially get them sicker. And so, you know, the idea that, well, this is just a common cold in adolescents isn't necessarily true. And also, if you think about just in general how risk averse we are for kids, we don't want our kids to face even a small risk of a catastrophic outcome, it really does make sense to vaccinate, given where we are right now.
Does the vaccination trends for kids look pretty much the same as adults? Is there a nuance there that you've gleaned at Johns Hopkins?
I think it's a little early to say too much about where we are, but I think there probably will be regional differences. I think that it's important to build parents' confidence first, have a lot of kids vaccinated and have them tell their friends, and just generally get word of mouth going and other things in order to get people confident about vaccinating their kids. But it's also important for the federal government to be updating people on the safety of the vaccines for kids, just like they were doing for adults and pregnant women and others.
What's the threshold, Dr. Sharfstein, for moving into a post-pandemic reality where we treat COVID like the flu?
I think we're still a little bit a ways from that. I'd like to see there to be so much vaccination that really the number of cases and the risk is hopefully, about an average flu season or less. I mean, that would be, then you could kind of treat it like the flu, but we're not at all near that point. The projections are that if we don't vaccinate more people, we will have many, many more people sick and a lot of people dying, far in excess of the flu. And so, we're just going to have to keep treating this like it is until we get to that point.
What do you say, Dr. Sharfstein, then to people who are sick of this, who want to move on with their lives, want to see people, want to travel? You're seeing people refusing to wear masks in increasing locations, saying that you can see that the virus counts are trending lower. What's the risk of losing credibility with the public by hammering home the ongoing social distancing and measures that you say are prudent in order to get the virus levels down to a level where we can move beyond?
Well, I think that the social distancing and those sorts of measures should reflect the state of the epidemic, the pandemic in a particular region. So if there are no cases, there's not a need to, have a mask mandate, for example. But I think at the same time, the concept that it could come back shouldn't be some sort of, crazy thing to say, because it could come back. And the way we keep it from coming back when weather gets cold, when people come together, is through vaccination. And so I think the focus as the cases come down should shift to, continuing to make the case for vaccination. And, in the end, that's just the way it is. We can't psychologize our way out of the virus. The virus is waiting for us. And we really need to emphasize what we can do together to keep there from being a false surge.
Well, and it could come back stronger and more dangerous, right, Dr. Sharfstein? This is my concern with the anti-vaxxers or those who don't want to get vaccinated for whatever reason, could pose a danger still to the majority of people who do get vaccinated, in that they could carry this virus and allow it to mutate into something that ends up overcoming the efficacy of the Pfizer and BioNTech vaccines.
I mean, in theory, that's possible, but I just think it's terrible if they themselves and others who've been misled and haven't gotten vaccinated get sick. And that's basically a sure bet to happen if we have a major surge again. So, one of the things is, from the very beginning of the pandemic, every time cases went down, there were people out there declaring victory. Now cases are going way down, so it's extra tempting to declare victory. Mm-hmm. But we're not in that spot yet, and we have to find ways to communicate, both that, yes, we're in a better spot, we can do more now, but if we want to continue to be improving and not risk a big problem in the fall, we have to continue to encourage vaccination and get the numbers up, to a level where we shut the door on the virus really causing a big problem in the fall.
Dr. Sharfstein, thank you so much. Greatly appreciate it. With Johns Hopkins, the Bloomberg School of Public Health, of course, Mr. Bloomberg, principal owner of this television and radio operation as well. It is an extraordinary headline. It is a headline of courage. It is a headline, frankly, of surprise. Jeffrey Bezos, with his brother, will travel into space. They will be going on New Shepard, named after the great Alan Shepard, and they're looking for someone to go with them. And there's a whole thing out at the Blue Origin website where you can pony up a fee. We want to announce that the Matthew Miller Patreon Fund to put Matt Miller into space. We'd like to say keep him there. is with us. Matt, I think, I know you're into cars and all that, but this is really something that this guy's going to actually just shut up and do it and go up there.
To me, it's unbelievable because he's worth $186.8 billion. He alone, not even including the fortune of his ex-wife, is the richest man in the entire world, over Musk, over Gates, over Buffett, and he's going to risk that fortune.
New Shepard, the flight experience, Mach 3 Plus. They go up to apogee, which is above the so-called Kármán line.
Matt, you're going to let this go? Tom just tried to send you to space and keep you there.
I'm willing. I'm ready and willing.
They're up to like 2.8 million, I think.
Question, though, about the idea of recreational space travel. How close are we to that moment?
We're going to find out. Really something, really remarkable. And of course, we'll have our continuing space coverage led by Riley from St. Louis. We're really looking forward to that here in the coming weeks. Maybe Mr. Musk will top him and go into space with a Tesla. This is Bloomberg. Good morning. Stay with us.
It's hard to have much of an inflation problem if wages are still quite quiescent.
We're recovering very quickly, but a lot of people aren't coming back into the jobs market.
People will get more comfortable coming back to work, but they're demanding more wages to do it.
The market's a little too complacent about the Fed not even talking about tapering.
We are still awash with excess liquidity, and that helps to support a lot of valuations.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on television, on radio, a simulcast on a Monday. Really, really easy conceptual ideas out there. G7 treaty, this, voting rights, that. A little bit about the market, but in the market, Lisa Abramowicz, I got to say, I got a 157 yield. That is different from 5 days ago.
Yeah, the idea here is that the balance of movement might even be lower, that the Fed is right, that inflation is transitory, and that perhaps the jobs market isn't picking up as quickly as people had previously expected. And we did see a bit of a gain in terms of the yield, price down, yield a little bit higher today after Friday's move, but nothing to write home for. The idea here is we're in a low yield regime for the longer term.
John Ferro off today, folks. Romaine Bostic in to assist forward. Romaine, I got to get up to speed on the memishness of this Monday morning. I've actually heard absolutely zero about it. Is that so done?
Well, I mean, at least for now. I mean, it looks a little bit less memish this morning. I think some of the bloom has come off of that rose, and I think a lot of people are focused in on some of the more tangible factors that have been driving this market, things that have a lot less to do.
We have to stop the show. I mean, on radio, this is spectacular. Romaine and I went back and forth on Friday, and we decided orange was the color of our bow ties for today. And Lisa, she was...
I just failed.
She was like tasting wine or something this weekend and missed
I may have been.
The orange bow tie. On radio, we welcome all of you as we are ensconced in orange bow ties. This morning, seriously, Romaine, I mean, GameStop, Joe Feldman walks away from it at Telsey Advisory Group. Is anybody walking away from AMC?
Well, I mean, pretty much all the analysts were relatively bearish on this. Keep in mind that into last week, the highest price target on this thing was like $6.50, and you had a couple of folks down at $1 here. So the fundamental bearishness, I think, that existed, at least amongst the sell-side analysts, that's still there. As far as the euphoria amongst the retail traders, I think you're seeing the volumes come down a little bit this morning, at least relative to what we saw over the past couple of weeks. Whether that actually is going to be enough to drag this stock even further down, who knows? It's still up slightly here in pre-market by about 3%.
But now there's a moment of reckoning, Tom, and that is that the Russell is going to potentially come out and shift AMC, shift GameStop into the Russell 1000, which makes them less of a weighting. This matters because basically these meme stocks have become a significant proportion of indexes that people track with their 401ks. And you do wonder what the implication is going forward.
We're going to go to Emily Wilkins on all that's going on in Washington. Really got quite a news flow for June in Washington. Right now, let's look at the data. Red and green on the screen here. The resiliency of the equity markets has been noted near record highs off of Friday, and with the VIX with a 16 level, 16.96 on the VIX. Again, Romaine, I'm going to let you do the yield space. years, 1.58%,
Yeah.
and the 10 years, a wow statistic.
Yeah, and this was actually an interesting move we saw on Friday because we keep talking about how the fixed income market, the Treasury market at least, really wasn't reacting much to a lot of the data and a lot of the Fed speak. We finally got that reaction on Friday with that 7 basis point drop on the 10-year yield. You're seeing the further decline in those yields today here. I think that gives you a sense here that now the market has found a little bit more clarity about what they think the Fed might start thinking about doing, and now you're going to start to see a little bit of movement here to the downside.
We got a lot of M&A going on as well. We're going to blow past that here at the top of the hour, but we had a huge LBO in the healthcare business over the weekend, and just in the last 10 minutes is presumed KKR involved in a transaction and Blackstone involved as well, the sum of which is nicely over $10 billion. We'll get more on that here in a bit. We need to get briefed because we picked the orange apple, the orange iMac.
The orange iMac.
Orange.
Perhaps the orange iPad Pro, which has wireless charging and will be in the Keene household in a brown box within perhaps the next 12 months. Apple is going to be hosting its annual Worldwide Developers Conference, second year that it's actually virtual. We're looking at the share price right now, down 0.2%. Amazing that it's not down more considering the tax implications over the weekend with G7. But really, it is all about cash flow, the massive cash flow that the likes of the Keene household funnels into this company. Then today, President Biden is going to be speaking with the key architect, the leader of the Republican effort. That would be Senator Shelley Moore Capito. She's going to be talking with him yet again. No deadline. This is a good thing. The infrastructure bill looking more likely given the fact that there still are talks ongoing and there haven't been firm ultimatums in terms of deadlines or in terms of numbers on either side. And this I really love. That young teens, 12 to 15-year-olds in Germany, can start getting COVID vaccinations for the first time starting today, really highlighting where we are in the COVID pandemic cycle. We are entering a new phase with the lowest rate of infection in 3 months globally, the lowest rate of infection in the U.S. going back to March 2020. Are we there yet, Tom? And that is what we hopefully can say the answer is maybe. Close?
You know, as Mr. Bremer would say, Dr. Bremer would say, every nation for itself. And certainly we've got a nice set of stories out there, some very good news stories, maybe the cacophony that we see in the United Kingdom, and some difficult stories out there still on lockdown as well. We begin strong in this hour. Troy Gajewski joins us with Skybridge here on the making of alpha, beta, gamma, and the rest of it within the hedge fund business. Troy, I see all sorts of articles that it's been a really, really whipsaw challenge 6 weeks or so for the hedge fund business. How is it? Is there alpha out there?
Yeah, but you're right. It has been challenging, particularly in long-short equity, really starting since February. And what we saw is that, remember, and this gets back to some of the inflation concerns and where the Treasury yield is now, is that, the industry was really positioned for, slower growth, potentially, less fiscal stimulus coming. And so they were overweight growth and stay-at-home names to some extent. Those have underperformed recently, and a lot of the value cyclicals have really screamed. And so it's been a choppy environment in long-short equity. Last year was a very strong alpha year. This year's been a slight negative alpha year. So it's been harder in the equity part of the capital structure. That being said, if you look at distressed debt managers or those in structured credit, they're principally recovery/value plays. So those have performed very admirably through June 7th so far this year.
We could talk all about that, Troy, but really everyone wants to know about Bitcoin and your holding in the crypto asset, considering the fact that you have made such a big push saying that this is going to be the key determining factor in your outperformance this year. Where do you stand on that now, given China's noise around potential crackdowns, regulatory issues, and the fact that we're perhaps moving into a new regime of liquidity?
Yeah, so look, we step back and still look at the initial thesis, right? You still have tremendous money supply growth. The Fed is still expanding their balance sheet by $120 billion a month. M2 is on pace to grow somewhere between 15 and 17% this year. You think of every central bank and every nation state is still in a debasement period for their currencies. So the macro environment is still very favorable. And as you were talking about before, it doesn't look like there's any urgency for the Fed to taper. They may announce a taper at the end of this year and start to taper sometime early 2022, but that's the most likely path. And then from an adoption standpoint, again, we still think we're very early. You look at some of the high net worth or the wealth management platform products, Morgan Stanley's has raised $150 million already. You look at gradual adoption in the hedge fund industry and the asset management industry, that continues. And then lastly, we're still relatively early post-halving. You know, the last halving was May 11th of last year. Typically, you have an 18 to 24-month bull market. So we still think we're in a bull market. Obviously, we had a very horrific correction, but we think the trend line is still up here over the next 3 to 6 months.
And you think there's a floor built into that, Troy? I mean, because a lot of people look at the current prices, they wonder about some of the institutional embrace of this and whether that's going to be enough of a floor to keep things from going lower.
Well, yeah, so obviously after the big dislocation we had, we built up a nice stability zone here in this 33 to 36,000 level. It will be hard to push meaningfully above 40 to 45 in the near term. But again, if you go back and look at previous bull markets, you had substantial corrections along the way. This one was obviously more profound. You do highlight a good point on the environmental concerns, is that may slow down some institutional adoption. But again, if you step back and look at your choices for how you play currency debasement, if you care about liquidity and you care about non-correlation, you know, Bitcoin in particular is still a very strong choice for you, alongside gold and maybe to a lesser extent copper. But copper, of course, you know, it's a very cyclical recovery play that's already rallied. You know, it's up 100% over a very short period of time.
Troy, I want to talk about the big tech, big cap. We've got the Apple conference today, something that we'll be covering, of course, across all of the afternoon. Troy, there's a comfort factor for hedge funds to own those companies. Describe the intellectual process of hedge funds loading the boat on large cap profit-making tech.
Yeah, loading the boat's a strong term, Tom, because I think there is some distinction in which names they own. But the industry particularly is as long Facebook and Google as we've ever seen them. You know, when you have great value investors like Seth Klarman with, you know, 2 of the top 10 names are Facebook and Google, for instance, that says a lot. And, you know, so the intellectual process is pretty straightforward. It's like, hey, we're going to be mean reverting here to a slower growth environment again after a big cyclical growth period. You have tremendous profit margins, tremendous cash flow generation. There's really no cost pressures in terms of, you know, expenses, meaning it's not a labor intensive industry that's going to suffer from higher wages, for instance. And, you know, on a valuation standpoint, they haven't been cheaper relative to the broader markets pre-pandemic days. So, you know, as hedge funds filter through their choices, if you're filtering for risk-adjusted returns, particularly in an environment that'll mean revert to slower growth, those look like standout winners to the hedge fund industry.
Troy, thank you so much. Troy Gayeski, a briefing there on the state of alternative investments with Skybridge as well. Romaine, I think this really folds into what you're going to deal with this afternoon. You know, Apple's going to go out and chat it up as well, but there's a raging debate about cyclical value rotation versus, hey, you got to own some of the big tech.
Yeah, and a lot of that debate, though, is really about how you define what is value these days. And a lot of people look at Apple and they throw it into that category. That's become the safety valve for a lot of people in this market. They fall back on it. And then they, you know, fall out of favor with it, and then they look at that revenue growth, they look at that margin growth, and they come back.
Yeah, and Lisa, you and I are dealing with this. I mean, the reality is you get the terse little 2 paragraphs from the school, and they say, you know, for the fall, Ignatius needs something Apple-like.
Yeah, someone needs an iPad,
or whatever,
like,
you know,
whatever, iMac. You know, honestly,
whatever.
Yes, which is the reason why all of these regulatory concerns, antitrust concerns, shrugged off. Really, it doesn't matter what the headline is. It doesn't affect the shares.
You opened the show with that, and you are dead on. We're seeing that shrug off again. Stability in the equity markets. This is Bloomberg. Stay with us.
With the First Word News, I'm Ritika Gupta. U.S. Treasury Secretary Janet Yellen says higher interest rates would be a plus for the U.S. and the Federal Reserve. In an interview with Bloomberg News, Yellen said President Biden should push ahead with his $4 trillion spending plan, even if it triggers inflation. She says any spurt in prices resulting from the rescue package will fade away next year. Some of the world's biggest tech companies are welcoming the G7 agreement on a minimum corporate tax rate of 15%. Facebook says it's a first step towards certainty for businesses, and Amazon says the process will lead to stability in the tax system. The agreement is designed to help countries impose taxes on tech giants such as Facebook and Amazon, but it may not be implemented for years. Google will pay $268 million to settle an antitrust investigation in France, and it's agreed to change the way its business works across the world. France's antitrust agency said that Google used its dominance over ad sales and purchasing on its platforms to distort the market, hurting rivals such as Rupert Murdoch's News Corporation. And a couple of big deals in the news today. According to Dow Jones, Blackstone Group has agreed to buy data center operator QTS Realty Trust for roughly $6.7 billion, that representing a 21% premium to QTS's closing price on Friday. Meanwhile, Macquarie Infrastructure has agreed to sell Atlantic Aviation to KKR. The deal values the airport services company at almost $4.5 billion. Atlantic Aviation offers hangar space, aircraft maintenance, and other services. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
There's no, hardwired deadline. We are doing the work of legislating. This is a big week, so we won't do this forever. But right now, there are good faith efforts on both sides, and we're going to continue the work of, doing our job and trying to get a bipartisan agreement.
The Secretary of Commerce, Gina Raimondo of Rhode Island there, managing through. Everybody's returned here on a June 7, and well, we are going to have an active June, to say the least, in government. An active market this morning, red and green on the screen, but a stability to equities with Dow futures up 29, S&P futures -2. I really want to point out as well, Brent crude sustains near 72, rounded up on Brent crude. Dollar with a little bit of a rebound. Matt Miller mentioning the 6 o'clock hour, 121.59 on euro. Romaine Bostikin for John Ferro, Lisa Abramowicz, and Tom Keene. We welcome all of you on radio and on television. Emily Wilkins joins now from Washington. Emily, what is the spillover of the senator from West Virginia speaking with such clarity in an editorial in West Virginia on voting rights? How does the Manchin effect from that spill over into other domestic issues in Washington?
Well, I don't think it was a huge surprise for those of us who have been very closely watching Senator Joe Manchin to hear what he said in his op-ed over the weekend. I mean, I think to a certain extent, this really emphasizes exactly how much Manchin wants to see that bipartisanship, wants to see sort of the Senate be fixed in a way, sort of overcome some of these partisan tensions. And that's something that's got to be weighing on President Biden's mind this morning as he debates whether or not to continue negotiations with Senate Republicans over the infrastructure package, or whether to say, you know what, we need to cut ties, we need to go it alone, we've got a lot of work to get done. Because remember, even if they go it alone with just Democrats, that doesn't mean that an agreement comes together like that. It means that we got to spend more time getting Democrats on board, because you've got so many different moderates and progressives who want different things out of this bill.
It almost reminds me of Speaker Boehner years ago. You say he's got to get just Democrats on board. Isn't that impossible right now?
I don't know if they would say it's impossible. It's certainly something where we talk to Democrats. They say, look, we want to get something done. There is widespread consensus across the Democratic Party that they do want to get some sort of package done. What that looks like, what the tax increases are, all of that stuff is being debated. But there is a sense that everyone wants to get to yes on the Democratic side of things.
All right, but we heard from Chris Van Hollen basically saying, Emily, the time here is perishable. And there does seem to be a clock that's been ticking right now for Biden. The idea here that if this doesn't get done, or at least something, I guess a handshake agreement at least doesn't get done within the next few weeks here, this might not get done at all this year.
Right. I mean, Democrats are really worried about seeing a repeat of what happened back in 2009 with the Affordable Care Act on health care, when they negotiated with Republicans for months and months and months, and no Republican signed on to that bill. I mean, think about the timeline here, too. If they can get a bill to pass this year, it's going to take time for the money to get out there, to trickle down into communities, and in the infrastructure component for shovels to go into the ground and people to start seeing the benefits. Democrats want all that to occur before November November of 2022. And that's something that they are taking into their calculations when they're putting pressure on the president to say, hey, we want to see something happen in a bipartisan manner, but the clock's ticking it, and we got to decide whether or not we need to move on our own.
We're speaking with Emily Wilkins of Bloomberg Government about the potential or the lack of potential for bipartisan agreement on infrastructure. There is, however, an emerging bipartisan agreement on something that may seem sort of fringe-like, but actually really caught my interest over the weekend. Senator Mark Warner of Virginia came out and said that companies should be mandated to report, to disclose whether they've had to pay some of the ransomware bribes, basically to pay out people in order to release information. This goes to the Colonial Pipeline disruption that we saw earlier, and it raises questions even about whether paying some of these ransoms should be made illegal. How much bipartisan support is there? I mean, this could potentially actually have a real effect on the market.
No, that's an absolutely great question. And I think it's one that Congress is really starting to grapple with in a bigger way now that we've seen some of these high-profile companies be hacked. The SolarWinds hack earlier this year certainly was at an enormous scale. And so you do have a sense, and I think it is on sort of both sides of the aisle, that there is some concern about what happens when companies pay this amount to hackers. I think this is a debate that's still really unfolding in Congress. I mean, the Senate was out all of last week, so now they're back this week. I would expect to see sort of more conversations about what exactly needs to be done. Of course, Republicans, there's always some hesitancy about telling the private sector what to do, but I think there's also a sense that there's some big concerns about what it means for Americans when you see companies like Colonial Pipeline get hacked and gas prices shoot up.
Emily, which Democrat are you watching this week away from the big names? Who really matters in Washington this week?
That's a really great question, Tom. I'm going to stick to the Senate because the Senate is the one back in session. And I think, we talk a lot about Joe Manchin. I think Kirsten Sinema, her name gets thrown out there as well. But there are a number of other moderate Democrats to watch for these things. Angus King, Jean Shaheen, even Mark Kelly.
Well, let's go to Angus King. Let's go to the gentleman from Maine as well here. What is Angus King's power in negotiation with the President of the United States?
I mean, Angus King, as a moderate Democrat, he can sort of try and make some inroads between Senator Manchin and President Biden, because he's someone who Manchin can sort of look at and say, look, this guy's an independent. He caucuses with the Democrats, but he still has sort of that independent streak to him. And that can be someone who sort of helps shape Manchin's thinking on certain things. I mean, this isn't a vacuum here. Certainly the senators, they speak to each other, they talk with each other, and I'm sure there are plenty of discussions between more moderate senators of the party and sort of where they think they can go, what pressure they might be able to exert on the more progressive members of their party, as well as party leadership.
Emily Wilkins, thank you so much from Washington, a briefing there on a Monday. A very, very active week, much busier than I thought it would be here in early June in Washington. Lisa, to prepare for our interview with Matthias Cormann, really interesting with the OECD, a gentleman from Belgium, a gentleman with I'm going to call it Germanic education, and he lands up in Perth, Australia.
Yeah, there's a question of the international feature of the business world post-pandemic. Also, I am curious to know the idea of global inflation and global growth when you talked about something very important, Tom, which is the very country-specific nature of this pandemic. And I was reading a story over the weekend about how small businesses in developing markets have just gotten eviscerated by the pandemic. What does that do to growth, considering how many of the jobs they supply in the world?
I can say the same thing in the United States as well. I mean, Romaine, you look across the equity markets, and we really haven't had in the last number of weeks this debate about small cap, call it small business, mid cap, and the large cap companies. I mean, that's an open debate into the summer.
Yeah, it remains an open debate, and that's why you see this sort of rotation in and out of these stocks over the last really 8 weeks now. Yeah, I mean, and a lot of people really trying to figure it out, and a lot of that really does hinge, once again, on monetary policy, and to a certain extent, a significant extent, to what happens with fiscal policy and whether Biden is successful in some of these proposals.
I want to draw everybody's attention to William Dudley writing actively for Bloomberg Opinion. His piece a week ago I thought was just extraordinary on the sequence here that the Fed would look at. And today he just simply comes out, Bill Dudley, the former president of the New York Fed, and said this is a Fed that has moved out to extremes, to use his language. That'll be an important essay for all of economics today. Red and green on the screen. Dow futures up 36, 34,779. We say good morning to John from Coventry. This is Bloomberg. On radio and television, Bloomberg Surveillance, John Ferro, Lisa Abramowicz, and Tom Keene. Good morning to all of you. Jonathan Ferro is off. Romain Bostic with us this morning. On the data front, the yield on the 10-year speaks volumes, 1.57, rounded up 1.58% after a stunning move on Friday off of jobs. The real yield, well, it churns here, negative 0.86% as well. And in the equity markets, we near record highs. We continue to sustain ever so slightly red and green on the screen, but the VIX a constructive 16.91. On the equity markets, Romain Bostic.
Yeah, and remember, Tom, on Friday, we actually traded above that record high on the S&P 500, and a big part of the reason was because of sort of the reemergence of big tech. Keep an eye on big tech this morning and throughout the day. Of course, Apple has its Worldwide Developers Conference later today. We'll see whether that momentum with regards to this new product cycle and the embrace or the forced embrace of a lot of these products continues here. Apple up slightly here in the pre-market, up about by 0.2%. Also, keep an eye on Biogen. This is going to be huge. JP Morgan calling this the mother of all binary events. Of course, the cognitive disease drug that it's been working on that could potentially be sort of a treatment for Alzheimer's. The FDA is set to make a decision on that sometime today, probably after the close of market. Those shares, though, nevertheless, have been rallying over the past few days, up 3% here in pre-market. Keep an eye on Eli Lilly, Cassava, and a few others that would stand to benefit should this get approval. Then keep an eye on Tesla. Unfortunately, more bad news here. If you were planning to get your hands on that new edition of the Model S, this was the Plaid Plus edition. Elon Musk basically saying that's not going to happen right now. Not really clear. The share's down slightly here on the day, but they've been camped out right below 600 for the last couple of weeks now. Flip up the board, a few other names to keep an eye on. We'll give you your AMC update here. Basically about flat here on the day, down to about 1% here. The volume here way lower than what we've seen in previous days here, though we should point out this is still the biggest volume mover in the pre-market by a factor of about 10 to 1. Also, keep an eye on Progressive Corp. Interesting downgrade today over at Morgan Stanley, basically saying that as we all sort of leave the house now and start driving again, that means more accidents and that means potentially more claims for Progressive that could weigh on margins, something to keep an eye on there. And finally, just want you to keep an eye on G3 Apparel. This company, of course, licenses a lot of brands like Donna Karan, Calvin Klein, Tommy Hilfiger. They just came out with earnings, and earnings were actually good, Tom. They did well in the quarter, and they guided higher for the future.
Nice update as we stagger into the week here near record highs. Interesting to see where we'll be on Friday. This is a great joy for Bloomberg right now after the 15 years of public service at the OECD in Paris. Angel Gurria has retired. And after a really interesting nominating process, the OECD selects the Pacific Rim. The heritage of the OECD and the previous 5 secretary generals has been Denmark, Netherlands, France, Sweden, France, and then it changed to Canada and Gurria's Mexico. Now the OECD reaches across the Pacific Rim. As Kishore Mahbubani of Singapore says, it is the Asian century, and part of that is Australia. Matthias Cormann is the OECD's newly appointed Secretary General. Mr. Cormann, wonderful to have you with us today. And you dive into a treaty and the complexities of a G7 effort to tax the larger companies. A treaty makes it very, very difficult as well. How will the OECD monitor and study the treaty effort to make taxes uniform at 15%?
Well, firstly, good to be here. Secondly, the globalization and the digitalization of our economies has created distortions and inequities when it comes to the capacity of governments around the world to raise the necessary revenue to fund the public services and supports they provide to their populations. And the only way you can solve a challenge like this is through a global solution that is multilaterally agreed. And in that context, the OECD has been working for many years to help improve the global taxation arrangements, to make them fairer, to make them work better. Now, at the G7 on the weekend, a landmark historic agreement was reached, and that goes to 2 important components. One, to ensure that digital companies, large digital companies, but also other large companies that operate multinationally around the world pay their fair share of tax in markets where they generate significant profits, and secondly, to ensure that multinational companies are not able to structure their tax liabilities, seriously minimize or completely eliminate their tax liabilities anywhere around the world, taking advantage of tax havens and so on. And so, ultimately, this is one step in the process. There will be other steps to follow. The OECD facilitates a process that is called the Inclusive Framework, which brings together 139 countries and jurisdictions from all around the world. And of course, ultimately, at the G20, a further formal agreement will have to be reached. But the fact that G7 economies, some of the biggest economies around the world have agreed to this reform is a very significant step forward in making sure that there is a globally more fair and sustainable taxation framework in place.
Before you went to Perth, Australia, within your Belgian economics, you studied the Wilsonian effort coming out of Versailles and how all of League of Nations collapsed basically with the U.S. Congress and the U.S. Senate. Is the OECD and a G7 or G20 tax regime at the beck and call of the American legislative branches?
Firstly, I have to say that the Biden administration has been very helpful in facilitating a consensus at the G7 on the weekend. The Biden administration and Secretary Yellen took a very constructive approach to multilateralism, helping to unblock what had been a difficult dossier up until that time. But of course, ultimately all countries that are part of an agreement, an international agreement, ultimately have to work these issues through in their domestic context, including in the context of their parliaments. And that is obviously something that we hope the US will do in its own time in the appropriate way.
Matthias, G7 agreed to a minimum, at least, of 15%. Could you see that tax rate going above that 15%?
Well, look, it's important to ensure that we strike the right balance. The average across the OECD, the average corporate tax rate across the OECD membership at present sits at about 21 to 22%. There are some countries that are below the 15%. Quite a few of them are above the 15%. If we were able to achieve a circumstance where all multinational companies operating globally are required to pay at least 15% on their profits, I think that is a very significant step forward. Of course, there is still then space for the appropriate competition between different jurisdictions based on their fiscal policy settings and their tax mix in their respective jurisdictions.
Matthias, there's still a lot to do, as you were mentioning, and Tom was referencing how U.S. legislature may end up taking a lead role in what exactly this looks like. What are the main hurdles that you see in the ongoing negotiations as we head into G20?
Well, look, clearly, it's very important to have all of the G7 countries reach that agreement. But of course, we need to expand, the level of agreement, well and truly beyond the G7. And that's what the inclusive framework process will do with more than 100 countries and jurisdictions involved. And indeed, around the G20 table, you have a significant number of other large economies around the world part of the process. So, I'm quietly hopeful, quietly optimistic that ultimately, when it's all said and done, we will be able to reach an outcome, in the next little while.
Matthias, on the tax plan, though, can we go back to this idea here of when you're setting the revenue threshold here? There's been a lot of talk about how complex this agreement is or how much it will be, and the idea that companies will sort of be able to find loopholes to get below that $20 billion threshold or whatever the final threshold may be. How do you ensure that companies aren't going to find an end run around that with regards to the revenue component of it?
Well, look, you're now going well and truly into the weeds of technical implementation arrangements. I think the principles are very clear. Companies, large companies, that are generating significant profits in markets around the world, digital companies, but also other large companies, should be required to pay their fair share of tax in the markets in which they generate those profits. I mean, the combined effects of the globalization and the digitalization of our economies has meant that it has been possible for quite a number of large companies not to pay or to pay very little or not to pay any tax at all in many of the markets they operate. And that is just a matter of fairness and public confidence in the way our taxation system works. And that is something that the proposal agreed to by G7 finance ministers on the weekend would address.
Matthias Cormann, I am absolutely fascinated at your selection through the nominating process. Many of the other nominees for OECD are people very familiar to Bloomberg surveillance. They've been great help to us in our coverage internationally over the years. You are a different OECD Secretary General, and I want to go to your Australia, your Western Australia, and the idea of the debate over big, evil American tech companies. Maybe it's tangential to OECD, but this is going to be in the crosshairs. The fact is, Amazon out at the Perth airport has been a massive job creator for Western Australia. From where you sit with your finance work in Australia, and now you move to Paris, how do you dovetail? How do you fit together the European fear of American big tech with the reality that create jobs like at the Perth Airport Fulfillment Center?
Well, firstly, there's 38 member countries of the OECD, and the one thing that joins us all together is that we are all market-based democracies, and we are all committed to generating opportunities for the people in our countries to get ahead based on free market principles, and indeed, based on democratic principles and in the context of rules-based global trading systems. So I think you'll find that the things that we have in common are much stronger than the variances between different parts of our membership. Now, I bring to this job about 7 years' experience as the Australian finance minister, but I also bring to this job, my background as somebody who grew up in Europe, went to school and university in Europe, and so I guess the membership felt that I had a particular contribution to make, and I look forward to making it.
This has been wonderful. Matthias Cormann, congratulations as the new Secretary General of the OECD. Absolutely fascinating there to see. Lisa, just to me, just a stunning selection over the coming out of post-World War II OECD selections.
I'm curious about your question about Amazon. I thought it was a really good question. Well done.
I did okay there?
You did great.
Okay, can I go home? Okay.
Go ahead. No, honestly, you can go to space with Matt Miller. There's a question going forward about how much cooperation there actually can be, given the fact that a lot of European countries want to go after U.S. tech companies, and then you have the likes of Ireland, who are, basically benefiting from low tax regimes. How are they going to get on board with something that could potentially undermine that status?
The complexity here is just so much. And Romaine Bostic, this goes back to David Kostin's research at Goldman Sachs here. There's an overwhelming issue of big cap America tech, and that is their investment. Their capital expenditures worldwide are stunning. Americans need to know what Amazon's doing in Perth, Australia.
Yeah, and look, the OECD gets a lot of credit for pulling all this data together, but I think some of the complexity of actually implementing this is I think, also a little understated right now. It'll be interesting to see if they can wrangle all these countries and get them on board.
Well, understated is the red and the green on the screen. We've got a Dow that's elevated, SPX off fractionally, -1. I'm going to call it. We start the week strong in equities after that jobs report that we saw on Friday. Brent crude 71.69. Stay with us on radio, on television.
Consumers have lots of money in their checking accounts. We think they spent about 65, or they have not spent about 65-70% of the last couple rounds of stimulus. Loans are starting to pick up, and there's plenty of borrowing capacity. Companies have unused lines.
Brian Moynihan holding court on CBS. Face the Nation there. Believe it, over the weekend they were giving out free air conditioners at Bank of America branches across
that was 40 years
the nation.
ago.
For those of you internationally, is a steamy and hot weekend for most of America as well. We're all moving to Seattle. I guess they had a more cool, calm, and collected moment. Lisa, David Wilson came in and said, I'm doing something for Abramowicz. I mean, he really doesn't care about me. Lisa, this is way too complex for me. It's about the Fed, it's about bonds, and it's about exchange-traded funds. Lisa, I'm lost.
Well, the quiet move that the Fed made when it was going to unwind its nearly $14 billion portfolio of corporate credit holdings, including a large proportion of ETFs. Now, this really didn't move markets, didn't come as a big surprise. It's not that big of a number. However, it is a big component of the exchange-traded funds that a lot of people use as the quick way to get in and out of credit markets. Dave Wilson's been tracking that. And Dave, it raises a question. If it's not market moving, what is the consequence of the Fed's policy? And can you give us a sense of how big their presence is in the ETF world?
Well, it's going to be something to watch in terms of, can they get out and kind of leave the ETFs kind of unscathed in terms of their value. I mean, you're talking about 16 exchange-traded funds, holdings of more than $8.5 billion total. And maybe the one to watch is the iShares iBoxx U.S. dollar corporate bond ETF, the ticker LQD, because the Fed is the third largest holder of that ETF at a 6% stake, and it's their biggest single position at $2.4 billion.
Okay, stop. We got to explain this to idiots like me. Jerome
LQD.
Powell owns 6% of that ETF.
Well, Powell and the governors on behalf of the American public own 6% of the shares of that ETF. Yes.
Is that a lot?
Well, I mean, when you look at the numbers.
Am I outraged? I mean, really? They own 6%?
Yeah, absolutely. I mean, we've got all the figures on the Bloomberg terminal in terms of holdings. And, you're talking about the second biggest chunk when you go through these 16 ETFs. There's another one at the top of the list, and it's the Spider Fund, intermediate term, Spider Portfolio intermediate term, where they have a 7.2% stake. And you think about it, the bigger the holding, the more of a risk that when the Fed gets out, it affects the market in a meaningful way.
Romaine, this brings up the question, how much does the Fed own of AMC?
I hope zero. I think if we find out that they do own it, I would be a little bit worried. But you talk about LQD here, VCSH. I'll talk about junk too, because I mean, they did actually sort of support what can be considered the low end of the market, though it did actually seem to outperform, at least while the Fed was holding it here, Dave. Is there a general sense here that whatever the Fed puts back out on the market here, that's going to have any material effect on the pricing of these ETFs?
Well, they're going to try very hard not to have any effect as they get out. And when you talk about high yield, I mean, sure, the Fed's in 7 different high yield ETFs, but you're talking about a much smaller percentage of the overall investment, a little more than $1 billion out of $8.6 billion as of last week. So, I mean, sure, it's a piece of the puzzle, you might say, but it's not the biggest piece. It's really the investment grade ETFs where you've got to watch to see if the central bank getting out does have an effect.
Tom, if I were you, I would say stop the show and give a perspective here on why this is important, because this is actually incredibly important.
Discuss
if you remember,
why.
Back in March 2020, the Federal Reserve took an unprecedented step to come and support the credit markets, to directly buy corporate debt through ETFs and directly. A lot of people derailed this as basically a move into moral hazard. Basically, what does this say to corporate borrowers that if there is a trouble period of time, the Fed's going to come in, back you up, and lower your borrowing costs? Now the Fed is coming out and saying, look, we're done. We've done our job. And there hasn't been a market movement. The takeaway here is the Fed has successfully used this tool to affect prices, because prices surged after they announced this program. Yeah. They're not coming down after they announced their unwinding of it, which indicates, frankly, that it's been a success and it will be a tool going forward for them.
Lisa, thank you. And David Wilson, thank you as well. In spirited conversation. I have no clue what we talked about there. Romaine Bostic, Michael Purvis in the 9 a.m., and he's out with a blistering headline this morning. And Romaine, I think this really speaks of Q3, Q4. It's not that he's bullish. but he's maintaining non-bearish. We're hearing that from a lot of people.
Yeah,
They're really not bullish. They're just non-bearish. I love that. He's non-bearish.
Well, it's called meaning that they basically have to be invested. I think you get a lot of that sentiment, maybe not as well articulated as he put it, but I think you can see a lot of people in this market right now that feel like you have to be in this, that this isn't a market that's really going to crash. It's not really clear whether it's going to continue much higher as well, but there are gains to be made. And if you're a portfolio manager, if you're a market strategist, you basically have to be invested at this point.
I mean, Lisa, you're non-bearish. I mean, Abramowicz is non-bearish, right?
Let's not get carried away. There is, though, this idea here of Yuri and Tim are talking about the death of the 60-40 portfolio. You can call me non-bearish.
Is that still dying?
The pendulum of non-bearishness.
It is.
There is a question, though, going forward about, just whether you have an irrelevancy of the 60-40 portfolio or whether it consistently performs that way. Michael Purvis basically saying you can't abandon it, right? And that actually is important.
Well, it is. I mean, Romaine, discuss this, please. The pendulum of non-bearishness, I think, is where we are. I mean, we're making a joke about it, but it's serious.
Well, it is serious. And I mean, back to the 60-40, I mean, a lot of people have abandoned it. I mean, you still have some folks who will sort of talk about the general idea that you kind of maintain some exposure, of course, to that fixed income space. But as far as the 40, I mean, that 40 is now morphed into something well beyond just, I guess, traditional treasuries, traditional fixed income, and a lot of, I guess, quote unquote alternative assets are now in that 40. So, I don't know. I think it's just a new era for investing, and I think Purvis's comments seem to address that.
Let's discuss it right here. Simon Constable, which I think the essay of the year, the Wall Street Journal on investing, talking about rebalancing. Romaine Bostic, does rebalancing work?
I don't know. I think I'll stay away from that
There'll
one.
be a quiz in the 10 o'clock hour.
I think rebalancing works depending on what your objective is for rebalancing. As far as its broader effect on the market, I would probably
Lisa, what do you think?
No.
If you want a non-answer, the pendulum of
pendulum,
rebalancing. What do you feel about it? The pendulum.
I think everybody
I got a lot
knows.
to
I
learn
think
about
it's
the lingo
total
on
hot
this
air.
show.
I just throw words out. I do want to just note this. Michael Purvis will be joining Another Property on Bloomberg Television at 9:30 a.m. Eastern.
Oh, is that
so
why
we can ask all about non-bearishness pendulums.
Yeah, I think KKR is going to do an LBO for the Ferro property.
An LBO. I think, look, this is an important point because people, and it goes exactly, Tom, to what you opened the show with, this idea that 157 on the 10-year Treasury yield, a new paradigm. We're talking about something different right now than we were the 162.
Well, we were, but
Do you know I hosted The Real Yield on Friday?
Are you hosting?
Did you not watch?
Please.
I just assumed you were at home watching.
I was in the heart of the surveillance now. What I want to know on a June morning is does Tang have an expiration date?
Tang?
You tell us. You're the only one drinking it, let me tell you.
Tang Mimosa's a little flat this morning. Stay with us. David Riley next on radio, on television.
Recovering very quickly, but a lot of people aren't coming back into the jobs market.
People will get more comfortable coming back to work, but they're demanding more wages to do it.
The bottom line, though, is we're getting a big spike in inflation.
The market's a little too complacent about the Fed not even talking about tapering.
It's hard for the Fed to maintain the degree of accommodation when the output gap is closing fairly rapidly.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
The pendulum of a summer stasis. Good morning. Tom Keene, Jonathan Ferro, Lisa Abramowicz. John Ferro off today. Romaine Bostic very much in from dawn to dusk, burning the midnight and the dawn oil. Always here. We very much appreciate it. Tom, the longer that you give markets right now, the more they want to go up, even if there is news to push them down. And that is what we're seeing this morning.
The Friday read and the Friday gloom was really colored by being right near record highs. I mean, this is a market where the gloom crew is begging for the markets to go down. And I'm sorry, the bid is there. Is it there every day, Lisa? No. But the bid is there pretty much. We just go a little green on the screen here on SPX moments ago.
Yeah, it really definitely seems to be the momentum. And Romaine, even as you see the momentum heading into the close, it seems to be up as well. I'm wondering what the participation is like. In other words, who you have a sense of that's driving this trade.
Well, I think you're starting to see some of the institutions come back in. Remember, a lot of them had moved to the sideline because of that volatility. With the volatility tamped down a little bit, you saw the volume start to perk back up here. And you you also start to see a bid come back into, I guess, would be some of the more traditional growth and momentum names rather than some of the, I guess, more speculative names, if you will. That's why Friday you did see the S&P 500 tick above that all-time high. It failed to close there, but that was driven by your Microsofts, Apples, and I guess the more traditional growth year and to some extent value names.
And I think that, Tom, really a lot of this is underpinned by the Treasury market, right? I mean, inflation very much front and center.
Yes.
And the idea that we have some sort of stability that seems to be consistent regardless of the data, regardless of some of the Fed speak around tapering, seems to underpin this melt-up kind of feeling. Nothing has changed.
Yeah, but it's a melt-up, but I don't know if that's the right, is there sort of kind of like melt-up? Maybe that's where we are. I mean, double-digit returns, but, I'm just looking at, there's a bid on equities, and the backdrop here is you're telling me the yield should be 162, 165, 168. We hear out to 185. Some people talking 2%, and we're at 1.5772%.
And if you look at the real yield, it's basically the same too. I mean, it's not really increasing either. And it really raises the question, Tom, about if you do get taper talk, what does that do to yields? I mean, honestly, do you end up with actually lower yields because that stymies growth?
The only one expert on this is Romaine Bostic, sitting in for Jonathan Ferro here on Friday on the real yield. I look, Romaine, at where we are on the inflation-adjusted yield, and I wonder about inflation-adjusted equities. SPX flat, a little bit green. Dow futures up 48.
Yeah.
Now, look at the VIX, folks, to me is just extraordinary. 21 down to 18. Yeah. And then we grind down, and right now, 15.79 on the VIX. Romaine, that's a wow statistic.
Yeah, that's a wow statistic. When you pair that sort of drop in the VIX with the drop in the dollar, and then the re-embrace in treasuries here, and then fold that over with the fact that you still have an equity market, at least at the top line, that's right around record highs. The question is, what does that tell you? And I think what it tells you is this becomes now a story about duration, not only duration of investments, but really duration of the timeline of when folks start to think that the Fed might move. Right now, that's still pushed deep into 2023 before you start to see some sort of meaningful move.
To finish up on the markets, Euro 121.67, excuse me, and yen showing some yen strength, 109.25. Right now, David Riley joins us. Chris Verone, the technical analyst, just published moments ago with Strategas, and he simply says the ex-United States opportunity set grows. Verone looks at surprising technical strength in Brazil and Italy. Mr. Verone is on the same page as the good David Riley, chief investment strategist at Blue Bay Asset Management. You distill it all, David Riley, and you say EM debt is of acute interest. Why?
Well, I think in an environment where we have these extraordinarily low yields in developed markets, and you've just been talking about a negative yield on U.S. Treasuries, then I think it's natural to look where you're getting not only a higher yield, but where you have some risk premium, which is going to provide you with some kind of buffer against any pickup in volatility in the Treasury market. And I think if you believe, as I do, that we are going to move into a somewhat higher inflation regime, that the sort of low-inflation regime that's dominated global markets over the last decade or so is coming to an end, then commodities and therefore by extension emerging market debt typically do well or relatively well in a more inflationary environment. So I think emerging market debt is looking, I think, quite an attractive asset class.
Although inflation has to hit the sweet spot. It can't be too high, it can't be too low. Too high of inflation in the United States could actually be bad for some of these developing markets. So how do you determine whether we're heading toward a more dangerous spot of inflation or whether we continue to be flat in that Goldilocks zone?
Yeah, you're absolutely right, Lisa. It actually is quite a fine line. I mean, I do think that if we are moving into an environment where inflation is particularly in the US, is sort of in the range sort of 2 to 4% going through next year and beyond, then I think that's actually an environment where it's as you sort of suggest, that kind of Goldilocks to some degree. If we get a more serious and sustained rise in inflation, which then forces the hand of the Fed to be much more aggressive, not only in terms of tapering its QE, but also then in terms of bringing forward when it does lift off from zero rates and where ultimately rates end up, then we're in an environment where not only do you have higher inflation, but you've got increased growth risk as well. And that clearly is going to be a negative for a lot of sort of growth sensitive risk assets, and emerging market debt will be part of that. So you have to kind of track the data and make those judgments in terms of your portfolio construction.
So, David, I am curious, though. I mean, in past economic and monetary policy cycles, we tended to see a lot of central banks follow the Fed. They would wait for the Fed cues. This time around, we're not necessarily seeing that. We're seeing a lot of banks start to either move forward with some sort of normalization, or at least start to talk about it in a way that we haven't yet heard the Fed talk about. Why?
Yeah, I think it's a good point. And I think the reason we're seeing that is that some of the central banks, whether the Bank of Canada, the Reserve Bank of New Zealand, are starting to sort of say, even the Bank of England to some extent, are starting to sort of signal that they have more confidence in the recovery, and that it's time to at least be thinking about, or about scaling back the degree of accommodation, even if it's not outright tightening. I think one of the reasons we're not seeing that from the Fed is because the Fed has changed its monetary policy regime. It's moved to this average inflation targeting regime. And I think it's going to be very, very hard for any central bank, frankly, to be more dovish than the Fed is. And I think that's one of the challenges that's facing the ECB, even though Europe, I think, is in a less good place than the US is in. And why I think, we've seen some of this dollar weakness over recent weeks.
David Riley, is dividend growth and use of cash for dividend growth, is that a yield alternative right now, given where real yields are?
It is the case that you can start looking at sources of income from the equity market. I mean, what we know, of course, is that dividends aren't as reliable as coupons. They do get turned off or switched off, and you have to kind of factor that into the analysis that you're doing. I mean, I think it is the case that it still makes sense to have as part of your portfolio clearly some core fixed income, because it's a significant dampener to the overall volatility of your portfolio. But where you're looking also to generate some additional income, you have to kind of go off benchmark, if you like. So that would include emerging market debt, but it would also include things like leverage loans, collateralized loan obligations, where you're getting a yield pickup, but you've got relatively little in the way of interest rate risk embedded in the instrument.
David, hearing you talk, it sounds like you're risk on. It sounds like you are very optimistic about the global scenario, and yet recently you've been reducing risk on the margins in your portfolio. Where and why?
Yeah, I mean, I am optimistic about the outlook for the global recovery, the sort of global reflation story. The reason, and that's why we still have this pro-growth bias across these strategies at Blue Bay, but we have brought down some of the risk. And really, we've done that because of valuations, not because we have concerns about the fundamental outlook. It's because a lot of the good news that we're expecting is frankly already in the price. And you can see that, for example, when you look at sort of generic credit spread. So, the sort of symmetry or the asymmetry, if you like, around the upside versus, we get a bout of volatility, uncertainty around the Fed if we get a big inflation print on Thursday, for example, is such that it makes sense just to sort of dial down the amount of risk within portfolios.
David, thank you so much. David Riley there, particularly on capturing the yield with Blue Bay Asset Management, their chief investment strategist. Lisa, just to me, it's just still shocking where real yields are. And we heard that focus with an earlier guest on the 5-year real yield. Yuri and Tim are looking at that.
The interesting thing is that we've kind of seen an unwind of inflation expectations. We saw a huge surge up, and then you seen this unwind of it, which has led stability to the market, saying that we're not going to necessarily see destabilizing inflation. And yet you still have big thinkers coming out and saying, you know what, this time could be different. And to me, this is sort of setting up for a real pivotal next couple of months as we get increasing numbers of data points.
Romaine, where are you on this? I mean, the fact is the big and the little watchers, they make up the market. Yeah. I mean, we got two markets. We got people talking inflation, worry, surprise. And the fact is they got the yield where the yield is.
Yeah, and you look at you look at the inflation expectations as priced into the market, and frankly, they aren't a whole lot higher than what the Fed's target is right now, and it really hasn't moved a tremendous amount over the past few weeks here. I think the general consensus is that people are buying into the Fed's message that a good portion of this, not all of it, but a good portion of this is going to be transitory. I think the key thing to watch, and what we're hearing from a lot of strategists, is really wage inflation, Tom. That's the sticky one, and if that ends up going higher, then I think you could have some concern here.
Red and green on the screen with a VIX stunning 6.68. We had a 15 handle on VIX here moments ago. Stay with us on Apple. Must watch, must listen next.
With the First Word News, I'm Ritika Gupta. U.S. Treasury Secretary Janet Yellen says higher interest rates would be a plus for the U.S. and the Federal Reserve. In an interview with Bloomberg News, Yellen said President Biden should push ahead with his $4 trillion spending plans, even if they trigger inflation. She says any spurt in prices resulting from the rescue package will fade away next year. Some of the world's biggest tech companies are welcoming the G7 agreement on a minimum corporate tax rate of 15%. Facebook says it's a first step towards certainty for businesses, and Amazon says the process will lead to stability in the tax system. The agreement is designed to help countries impose taxes on tech giants such as Facebook and Amazon, but it may not be implemented for years. Google will pay $268 million to settle an antitrust investigation in France, and it's agreed to change the way its business works across the world. France's antitrust agency said that Google used its dominance over ad sales and purchasing on its platforms to distort the market, hurting rivals such as Rupert Murdoch's News Corporation. And a couple of big deals in the news today. Blackstone Group has agreed to buy data center operator QTS Realty Trust in a deal valued at $10 billion, that representing a 21% premium to QTS's closing price on Friday. And meanwhile, Macquarie Infrastructure has agreed to sell Atlantic Aviation to KKR. The deal values the airport services company at almost $4.5 billion. Atlantic Aviation offers hangar space, aircraft maintenance, and other services. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
It is a relationship in trade that has been marked by significant imbalance. I would say that there are parts of this trade relationship that are unhealthy and have, over time, been damaging in some very important ways to the U.S. economy.
Very good. Catherine Tai, the U.S. Trade Representative there, moving the dialogue forward. We welcome all of you to Bloomberg Surveillance. Massive correction in order right now. I was back 20, 30 years at 82 Devonshire Street with Uri and Timmer. We must surveillance correct to the new Fidelity Manse out by the old Gillette factory at 245 Summer Street. Is where the Timmer chart room is at Fidelity. Thank you for commenting on that. We're like launching into it's farther from Fenway Park. That's all you got to know, Lisa.
Serious correction.
There's serious correction this morning. Lisa Abramowicz and Tom Keene with Romaine Bostick. Thrilled that you're with us this morning.
Thank
John
you.
Ferro is off right now on Apple in a controversial call on Apple. Pierre Ferragu is with New Street Research. They do the soiree today. A lot of people are more optimistic. Pierre, you really push against the optimism on Apple. Why?
Well, that's thanks, Tom, for having me. That's actually really a question of the flip side of Apple's success in the last 12 months. So the company is on its way to ship 230 million iPhones this year, right? So that's the success of the iPhone 12, the first 5G phone, a phone that is selling at the point in time where most, affluent consumers have been like stuck at home, not traveling, not going much to the restaurant. So, but still making about the same amount of money, sometimes even a bit more. And so these consumers have been spending a lot of money on high-end consumer electronics, and this has benefited the iPhone very significantly. And now, what we always keep in mind in our research is that Apple is playing on a fairly closed garden. There are so many iPhone users, and so when you have 230 million of them buying a new phone in the last year, that creates a sort of a depletion in the market for the next year. And so what we anticipate happening is that the next iPhone lineup, the 12S, is probably going to be not as innovative as the 12 relative to the previous one. And then you'll have less people in the market with an older phone and more people in the market with a newer phone. And then last but not least, people will get back into restaurants and like rebalance their spending profiles. So the combination of all that calls for a very weak year for the iPhone from the fall of 2021 and into 2022.
How does the monthly plan concept change the refresh rate dynamics? The idea that you're not putting $600, $700, $800 up for a phone, but they rope you into some form of monthly plan. How does that change this guesstimate towards a bearish Apple call?
So that's a very good question, Tom. And I think the simple way to look at it is to look at it as a finance purchase. It's like taking a small loan to buy your phone. So a significant portion of the market is going to be triggered by their refresh plan. So they will actually take the opportunity of a plan coming to its end in order to buy a new phone. At the same time, what you'll see is that a lot of them will actually be also in a mindset of you don't really have plans. There's a very small minority that will replace your phone every year. It's usually every 2 years or even every 3 years. And so when that happens, what you can see is that a lot of consumers, and when I say a lot, it's a small portion. It's maybe 10, 15, 20% of consumers will actually play on the timing of their replacement, waiting for the next phone or taking an opportunity to change their plan, to go to a cheaper plan and things like that. So there is a lot in the iPhone market that is, I would say, in which there is a rhythm that comes from this contract. But at the end of the day, a very large portion of iPhones are still sold, independently from a plan. It's still like on a global basis, more than half iPhones are sold independently from a plan as well.
So what you're calling for is somewhat radical, considering the importance of Apple to so many portfolios, the idea of a 28% downdraft in the shares. And I'm wondering what the path is that you see getting there, given the incredible ownership and the incredible appetite for companies that have pricing power and incredible cash flow.
Yeah, it's a very good question. So I think what you'll see is that we are still like in fairly uncertain times. And so when you start having negative news flow about iPhone commercial momentum, you will have some sort of profit taking on the stock, knowing that profit taking on a more than $2 trillion market cap is kind of almost an absurd concept. It's going to be marginal, but prices move when there is a change in balance between marginal demand and marginal supply on the stock. And if you start hearing more and more news flow suggesting Apple is not going to have a good year, then you have more and more owners who were significantly overweight that will move slightly less overweight or maybe equal weight. I would expect very few of them would go underweight. And then if people see, a 20 to 30% decline potential in the stock, they'd probably stay on the sideline and wait. And then of course, like people buying the weakness will take some time to come in. And then there is another element that you need to take into account, that you still have a lot of money that is managed market neutral. And so a 20 to 30% decline potential in such a large cap is an excellent funding short. So you could expect to see, if things play out the way we anticipate them, a lot of long short money actually taking positions from that perspective.
Any possibility here for, I guess, a pivot or any sort of real innovation here? You're talking about 14 years now since the iPhone, 11 since the iPad. Tim Cook, of course, been there for 12 years. Very quickly here, Pierre, what's next? So it's a lot of things that are very exciting on the horizon of Apple, but none of them are really like on a 1 year horizon. And we'll see what they announced today.
But the things that are very exciting for Apple, I think, is like the evolution of the hardware portfolio towards a setup that will, enhance, like make possible augmented reality. So Apple coming up with a headset, with a pair of glasses, with more and more devices that can communicate to each other, position each other against, position themselves against each other. And that, I would say, is a 2 to 3 year horizon. And then, of course, my background and the interest I have on Tesla and on electric cars, and self-driving cars. And I think that is a monster opportunity for Apple, but it's still very open-ended and multiple years away.
Pierre, we're going to leave it there. Pierre Ferrago, New Street Research, just fascinating. As Lisa mentioned, an outlier call there with some real tangible caution on the iPhones. Lisa, what will you look for from Apple today?
Whether they actually have a real new product that could attract the likes of the Keene household to shell out $1,000 on a new orange iMac.
I think they're going fancy. I think it's like maybe they'll have a new chip today. Seriously.
Well, that actually would be huge. Or manufacturing their own chips.
Yeah. Red and green on the screen. Stay with us on radio, on television. Good morning. Good morning, everyone. Bloomberg Surveillance. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. Thrilled that you're with us. Mr. Ferro is off in Romaine Bostick holding court with us. Coming up, a really, really important moment on work from home. This will be required listening in about 15 minutes. Right now, and with great insight, Neil Dutta joins us through Renaissance Macro. This with green on the screen here. Futures, well, a little up fractionally as well. 16.86 on the VIX. Neil Dutta tears apart what we learned about the American labor economy on Friday, and driving forward what we learned about when we get to the vaunted 1 million units. Neil Dutta, what did you do to your x-axis off the jobs report on Friday? How much farther out till we see tangible labor recovery?
Well, it's a great question, Tom. I mean, it's coming a little bit slower than I would have hoped. And obviously, we got a head fake with the strong ADP number heading into the Friday jobs report. But I think over the summer, we should begin to see stronger employment growth. What the issue right now is not demand, in my view. We know that job openings are quite high. We're going to get more evidence of that later this week. The issue is one of supply. Prime age labor force participation rates haven't moved since last summer. And during that time, job openings have grown by over, like 2 million. So this is primarily an issue of supply. It's binding in the short run, and there are issues around why that may be the case. I mean, I think COVID is still an issue. I mean, you still had as many people saying that they had a job but weren't working because of illness as you did in May, as you did in March. So despite this drop in cases, COVID remains an issue. I think childcare is probably an issue, and I also think the unemployment insurance issue, which is the most contentious of all of these things, is probably an issue. And we're going to get a good test case over the summer. I mean, if jobless benefits, supplemental unemployment insurance goes away, then that should prompt more people to kind of attach to work.
I thought Heidi Shearholz with the Economic Policy Institute was really good in the New York Times, very thought-provoking, Neil Dutta, about just the idea of, between the demand and supply of labor, just raise the wage. Will the raising of wages be demand pull, or will it be cost push?
Well, I mean, it's not that. I mean, yeah, that's fine. But are we're going to celebrate this sort of boom in low wage wages? Wasn't the 2019 period? I mean, obviously, this was all happening before the pandemic too, right? We were talking about leisure and hospitality workers getting a lot more. Wasn't that a much better outcome for the economy? So I think it's a little bit premature to be celebrating this. Obviously, if restaurants are going to give out bonuses to workers to kind of join, that doesn't stop those that are already working at restaurants from also taking bonuses to go join somewhere else. Does anyone really believe that's a good situation for the restaurant industry? And what do you think that's going to do to future employment opportunities in that industry? I don't think it'd necessarily be the best thing. So, I appreciate the fact that low-wage workers are getting more. I think that's probably a good thing. But, the dynamics of what's happening now with the shortfall in that industry being so substantial. And remember, that's the industry that's seeing the highest rate of wage growth, but also has the biggest shortfall in employment relative to the pre-pandemic level.
Neil, there's a controversial issue here of whether higher wages actually slows growth meaningfully or actually leads to a fewer number of jobs and how that sort of feeds back into the economy. But there is a question also about how much these frictions are going to slow growth over the longer term. I mean, at what point do these frictions, do the incredible demand for workers paired with the lack of supply lead to a slower growth scenario for you than you otherwise would have said?
I mean, you're seeing that already play out in the short run, aren't you, Lisa? I mean, look at auto sales, right? You can't buy what you can't sell. And that's true of housing as well, right? I mean, so it's already starting to bite. The good news, of course, is that, service sector consumption is continuing to accelerate in a pretty linear fashion. So, we're talking about restaurants. It's important to note that, restaurant dining out is still sort of growing at a solid, pace. I mean, that's kind of offsetting some of the slowdown in these goods industries. But supply is binding in the short run. I mean, it doesn't respond as quickly as demand does, and you're beginning to see that. The question is, are these issues going to get better or worse over the next 3 to 6 months? And I think it'll get better. I mean, COVID is the first issue. We know that that's going to get better over the summer. Cases are going to continue to decline, and that should make people more comfortable about taking work, especially those sorts of jobs that require, face-to-face contact with people. Yeah. Schools are going to reopen. In New York, where I live, for example, they've said that it's going to be full in-person instruction. That's got to help the labor situation.
Sure, and we're all excited. I'm telling you, as somebody also who lives in New York with children, we're all excited to get them back into in-person learning. There is a question, though, just going back to your point about wage inflation and the sort of frictions here, and we don't know how long-lasting it will be. Bank of America put out research showing that wage inflation was already back to 2001 levels when you looked at durable manufacturers and the amount of jobs they had available versus workers that they could rehire. At what point do you take note of that? Could we see wage inflation that actually leads to slower growth that causes you to actually materially change your outlook?
I mean, you're seeing it in certain sectors, but I guess the issue for me is this a permanent state for the labor market, or is it temporary? I'd argue it's temporary because I think the supply shortage in the labor market is temporary. So, these headlines you're seeing about, restaurants or fast food dining handing out iPhones to teenagers for them to come work, or even what you're citing in the durable goods sector, that is not a permanent state of affairs. What we're seeing in the labor market in terms of what's holding back supply is largely temporary in nature, which means the constraints that you're seeing, these sort of things that you're pointing out, will also be temporary in nature.
All right, so let's assume that this does end up being temporary. Based on that belief, based on the data that we've gotten so far, Neil, you have to believe that Fed tightening then is still a little bit far afield here. You still buy into that general thesis? Do you buy into what Powell has been telling the market?
I do. I mean, the Fed's policy is to let the economy run hotter than any of us have ever seen, at least, at any point in our careers. And it's their policy to be somewhat irresponsible. And to me, that just means that, against traditional benchmarks, they're going to look like they're going a lot later than they otherwise would. I think that's going to be interesting for the markets because it probably means that once they start, they'll go a lot more rapidly. But I do think that they wait a lot longer than they had been in the past. I mean, a lot of people are talking about the Jackson Hole period being a kind of setup for tapering and all this.
Yeah.
I don't know. I mean, I know that's the consensus, but they've made some progress, but have they made substantial further progress? I mean,
right.
that still feels a ways off. And remember, they're defining this also not just in demand side terms, but supply side terms. Are they gonna start thinking about stepping to the exit door with the labor force participation rate basically unchanged since last summer? Remember, it's almost 2 percentage points below where it was right before the pandemic. I mean, and we know that before the pandemic, the Fed was sort of buying into this idea that their policy, basically letting the cyclical recovery ensue, would it in and of itself help the supply side of the economy by drawing people into the workforce? They were talking about that before the pandemic.
Right.
So why would they kind of signal some kind of an exit with the labor force participation, right? I mean, that to me that's the risk, right? Is that they have this policy where they're not just looking at demand side issues, but they're looking at supply side issues.
Right.
And that can get interesting from a future inflation perspective. So I don't think these are issues right now, but you could see this sort of playing out in the years to come.
Absolutely, but there's still risk in the messaging as well. I mean, whatever sort of weight we're putting on Jackson Hole, the general idea here is that Powell's still got to get everyone on board for actual action itself here. And I guess I wonder whether the messaging that we've gotten so far is consistent, or at least, I guess is consistent, with what the market is willing to accept.
Yeah, I mean, this goes back to the cacophony of Fed speak, right? I mean, I generally think that he has the board of governors on board with his strategy. The hawkish folks are generally regional Fed presidents that don't really have much bearing on what the actual policy outcome is going to be.
Dada, thank you so much. Greatly appreciated. From Renaissance Macro this morning. He's just been really, really brilliant on the supply and demand dynamics of the American labor economy. Romain, what do I make of this? I got a lift in the market. I mean, what's the why?
I'm not sure what the why is. I mean, you're talking about 0.1% here on S&P futures.
Go with us,
here.
Romain. It's the morning.
I don't know. There's something about a pendulum. I don't know. Bezos is going to space. Maybe that's the catalyst. Who knows, Tom? But what we do know is there's that bid that's been coming into this market. It has been persistent. It may not be spectacular. It may not be your 100% AMC type of bid. But there has been a persistent bid to the upside here on this market for the past few days here. And that appears to be continuing here, at least on this Monday. I don't know. Maybe call it clarity. We'll come up with a narrative after.
I mean, I haven't even brought up my meme stock this morning. AMC 49, up $1 roughly pre-market. I mean, I don't know. Lisa, what do I make of how memey are we this morning, Lisa?
Well, we go to cash. No, I'm kidding. I mean, honestly, I think that the fact that we've seen a return to the meme stocks just highlights how we've seen some of the frothier areas of the market regain steam. I personally, the narrative I would give this is we saw an unwind of the inflation narrative. And now we have this belief in the Fed that the Fed will get what they want despite some of the naysayers. The question is, will that last? Coming up, we're going to be talking about that and much of the action that we expect to see throughout the day. Woody Cesar, Wells Fargo Securities Head of Credit Strategy, joining us. We'll be sure to talk about the Fed, their holdings of ETFs. I know, Tom, you were really interested in that.
On top of that, yeah.
Look, I personally find this fascinating, the idea that if you have faith that the central bank has your back as a company, what does that mean in terms of your willingness to take on risk? Right now, the 10-year yield, 1.57%. I'll tell you, 156 would be remarkable. That is an adjustment off the jobs report that we saw. We're going to continue forward. We have a superb moment coming up with Nicholas Bloom of Stanford. For any of you considering the new work, this is must watch, must listen. This is Bloomberg. Good morning.
With the First Word News, I'm Ritika Gupta. U.S. Treasury Secretary Janet Yellen says President Biden should go ahead with his spending plans, even if they lead to more inflation and higher interest rates. Yellen told Bloomberg News that higher rates would be a plus for society and for the Federal Reserve. She says any spurt in prices resulting from the rescue package will fade away next year. In Mexico, President Andrés Manuel López Obrador's party took the lead in midterm elections for the lower house of Congress, but a survey indicates his coalition won't retain a supermajority needed to pass constitutional reforms. In Peru, the presidential runoff is still too close to call. Investor favorite Keiko Fujimori trails leftist Pedro Castillo. Fujimori is the daughter of jailed former president Alberto Fujimori. And New York oil dropped after hitting $17 a barrel for the first time since October 2018. Still, the outlook for demand remains bullish as vaccination rates accelerate, driving greater mobility. Oil prices are up more than 40% this year. And shares of Tesla are lower pre-market. The electric car maker called off plans to build a Model S Plaid Plus. That's the longer-range version of its high-end sedan. Tesla CEO Elon Musk tweeted that Plaid Plus will be cancelled because the Plaid version is, quote, just so good. And the world's richest person is going into space. Jeff Bezos will be one of the passengers next month when his company Blue Origin sends humans into space for the first time. Bezos and his younger brother will join the winner of an online auction the company is conducting. The suborbital flight is set for July 20th. That's 15 days after he is set to resign as CEO of Amazon. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
We still got to have to remember that, the economic hit to the economy, to jobs back last March, April, and May were devastating in a lot of ways. And we can't just flip a switch, but this is a positive report. Certainly, I would love to be able to stand here and say 7 million jobs came back, but unfortunately, that's not how the economy works, and that's not how the system works right now.
The Secretary of Labor is spirited there after the job economy report. It'll be interesting to see if we get a number of improvements in the report, how the tone will change from the Biden administration. This conversation has been hugely anticipated, and it does so because Nicholas Bloom, as a young student many, many years ago, was at the absolute forefront of labor dynamics, innovation, and technology. He did this with someone that's been of such help to Bloomberg on the Economy and Bloomberg Surveillance, the great John Van Reenen. And we're thrilled that Nicholas Bloom could join us from Stanford this morning. Professor, congratulations on your January 2021 paper, which is the discussion point on work from home. I want to go back to Bloom, Kretschmer, and Van Reenen of 2009. And what has changed is the technology has changed. Is the new technology the reason work from home will work?
It's been a very odd journey. So, as backdrop, I've been working from home since, I think, 2004. I mean, that's almost 20 years now. And it was normally a quiet backwater topic until, of course, March 2020, beginning of the pandemic, when it just went wild. It has changed a lot. My experience of working from home, the last 10 years have been kind of different because basically we got the two final critical pieces. We have video calls. So we can do this. We can have talks and Zoom and Teams over the internet. And we've had Dropbox in the cloud so you can share files. If you go back 20, 30 years, I talk to people that, do working from home in the 80s or the 90s. It was terrible. It was telephone calls and dropping off piles of paper at the front door. If the pandemic had happened in, say, 1980, we would have been in real trouble. I mean, we couldn't have worked efficiently. I'm not sure what the lockdown would look like. Thankfully, we had the ability to flip roughly 2/3 of the economy in March 2020 to working from home. It worked pretty well. In fact, it looks like a lot of that's here to stay.
Well, but is there a permanence to it? And let's go back to the hallmark. You did the paper with Van Reenen and Kretschmer in 2009. Marissa Mayer changed the world at Yahoo in 2012-13 with a great debate about Yahoo work from home. Drag that forward now to where Nicholas Bloom and Marissa Mayer can say there's a permanence to work from home, or like Marissa Mayer's, people would say, let's get into the office. Which is it?
No, I spoke to Marissa Mayer recently about this, and I think what she did is exactly right, but history's kind of forgotten what she did. So just to be clear, Marissa Mayer discovered that there were people that were working home full-time, and some of them were working so poorly they'd never turned on their computer for more than over a week at a time. So she said, look, A, you're going to have to come in, let's say 3 days a week. You can't work from home full-time. You're going to come in 3 days a week, and B, we want to monitor you and manage you and make sure what's going on. You're getting your job done. But huge numbers of firms are rolling out exactly this plan now. So you hear, Citibank and Apple and Google and Microsoft and HSBC, et cetera. The world is copying exactly that plan now. They're saying, look, post-pandemic, Yeah. You're going to come in probably 3 days a week in the office. Let's say Monday, Tuesday, Thursday. You work from home Wednesday, Friday, and we're going to manage you. We're going to check up on you and make sure that what you're doing your job. But as long as that works, you can continue that indefinitely.
All right, so that gets right to the idea here, Nicholas, about productivity and I guess the perceptions of productivity. A lot of companies, they want to look over your shoulder and know that you're doing the work that you're supposed to be doing here. What is your data showing here about the level of productivity during the COVID crisis with everyone at home?
Well, quite surprisingly, working from home appears to be slightly more productive than being in the office. So that's based on survey responses and on some data we've got on a few individual firms. My concern, and most firms' concern, is that won't last forever. So we kind of entered into the pandemic with this stock of what you might call social capital. So we've been in the office for years together. We knew each other. We've been creative together. I don't think that can last forever, what we're doing right now, working at home 5 days a week. So on productivity, the reason firms are going back is hybrid seems to be the best for productivity. You spend 3 days in the office, social, all your meetings or your team events or your client events are there. 2 days a week, quietly working at home when you save the commute and you actually better at quiet time. So it looks like that maximizes productivity. And employees love working from home hybrid. They love to get 2 days a week at home. So this is why this plan has been so universal. Is this really the best of both worlds? Firms are more productive, and we as employees are actually happy.
Well, what about career advancement? Another criticism of the work from home movement is this idea that you need that face time. If I want to move up in my career, I need to be face to face with Tom Keene every day so he doesn't forget that I exist.
Yes, exactly right. So again, the thing I've spoken quite vocally on, and it's been somewhat controversial, is career advancement is fine as long as you are coming in the same number of days as the people you're competing against. So look, if I'm in a team of 10 people and I'm at home full time and the rest of them are coming in 3 days a week, you can imagine I'm going to get left behind. As long as the whole team comes in on the same 3 days and stays at home on the other 2, things are good because you're compared with people who are doing the same type of work schedule to you. No one's getting ahead with the boss because we're all coming in for the same number of days. So the big problem is firms that are going for this choice plan whereby they say, as long as you're doing your job, you can choose the number of days you come in. You can imagine that, down the road, it's going to be very problematic. Some people come in 1 day a week, some will come in 5, and those that come in 5 are going to get promoted and move ahead.
Nicholas Bloom, thank you for an early morning in Palo Alto. And Professor Bloom was Stanford at University. I really can't say enough about his January research on this raging debate of work from home. What do you think, Romain? Can we do surveillance work from home?
We could give it a try here, but I mean...
We did give it a try. Trust me, it's better in the office.
I remember that. Yes, it certainly is, I think, for folks like us. But look, I mean, to Nicholas's research, I mean, he makes some great points here, not only about the productivity side of the equation, but really about the work-life balance, and that there are sort of benefits, tangible benefits to the workforce by having that flexibility, even if it's just 3 days a week at home, maybe 2 days in the office.
I'm going to stay out of the debate, but I'll tell you, it's a huge debate right now. For those of you across this nation, and particularly if you're not in a job economy where you can work from home, in the work from home space, there really, to me, Romain, there's really no topic. There's no other topic.
Yeah, absolutely. And we should point out, I mean, this sort of applies to a very privileged class of folks out there, and there are a lot of folks that don't have that opportunity.
Yeah, I think that's really worth stating. There's been some really good work on that. I nod to Heidi Sherrills and Economic Policy Institute for some of their work on that right now. I also nod to Green on the Screen. Futures advance up 4. That's a big move off of where we were 3 hours ago. Dow futures up 76, the VIX 16.80 in this great bull market. Let us not forget Apple with some big announcements. What am I going to look at as an Apple nerd? I'm really interested in the chip technology of the M2 or the M1X, whatever it is, because that's what leads the way. Romain Bostic and the rest of our afternoon crew with Apple discussion here this afternoon. On Balance of Power, the former Citigroup vice chairman and New York City mayoral candidate, Ray McGuire.